Okay, guys, let's get started. Welcome. My name is Roy Maddox, and I am the host tonight of the Investors Business Daily Charlotte Meetup group, along with my son, Wesley Maddox, who's a co-portfolio manager for ifsinvest.com. We want to sincerely welcome you to the presentation tonight. We've been doing this for over 5 years, and I've been a member of the Meetup groups for over 20 years. Most of the concepts that we'll talk about tonight revolve around CanSlim, and that's the process that was developed by William O'Neill. That is where he's famous for writing the best-selling book, How to Make Money in Stocks by William O'Neill. So many of the concepts that we'll talk about tonight actually are derived from that book, and the principles that we adhere to, we will share many of those tonight. The presentation will be broken into 2 parts. In the first part, we will talk about the market environment, the current market environment, and Wes will take you through the slide deck. Now, we have a number of slides, and we put these together so that you can go back and study them after the presentation is over. We think that many of them are relevant and can help you make some well-established and well-grounded investment decisions based on the current information that you're seeing from the slide deck. Now, we do believe that it's important to have a process, and our process is based on a step stool having 3 legs, where you talk about the fundamental factors that have to do with earnings, sales, return on equity, margins, leverage, revenues, and the technical aspects that have to do with reading the charts and looking at things like the MACD indicator, stochastics, relative strength indicator, and so forth. And then finally, we think that the macro view is important. So the macro view gives you the narrative so that you can know what the backdrop in the economy is, so that you can certainly try to make the best decisions based on where you are in the economic cycle. And Wes will go through that presentation and talk about a number of these slides. Our group is a private group. It requires membership, but everyone's invited. We have about 1,400 members from all over the country. Many of the attendees in the meeting tonight will be from New York, Texas, Washington, and other places, really spread around all over the country. So welcome to all those that are tuning in outside of Charlotte, North Carolina. We've got a lot of important information to share tonight because the environment is so volatile today. And we're going to hopefully share with you and collaborate with you, with your input, so that we can certainly navigate through the current bear market that we're in. We're in a pretty devastating bear market. We view it as, in my experience, it's probably the 3rd worst bear market that I've been through in my career. And that's including 2000 to 2002, 2007 to 2009. And this would rank up there with them in terms of being the 3rd most difficult and challenging market that we've been in. So welcome, and I'll turn the format over to Wesley, and then when Wesley's through, we'll talk about individual stocks, and we'll pull up and answer most of your questions then. But feel free to, if you have any questions during the presentation, as Wes takes us through the slide deck, be sure and pause, and we'll get those answered for you. So let me turn it over to Wes, and let's get started.
All right. So yeah, feel free to drop the questions in the chat. I'll try to notice, but also you can interrupt me. No big deal. If there's a question.
And turn your volume up slightly, Wes, please.
Turn it up?
Yes, turn your volume up just a little bit, I believe.
Okay. I'm not sure if I can. Oh, oops. Let me see if I can change my mic. That's gonna be it.
Okay, that's good.
Okay. All right. Okay, so we already touched on this. We hit 1,400 members, so I guess we added about 80 members over the last month since the last meeting. It's just, we're scaling up. It's kind of nice to get people, like we said, all over the country join us on these monthly meetings. We touched on William O'Neill and how he's kind of the foundation of the meeting, and this CAN-SLIM acronym is something for you to review if you're not familiar. These 7 letters represent 7 key criteria that William O'Neill that he used in his investment process. So we'll talk a lot about each of these kind of throughout the presentation with individual stocks and the market environment in general. And like my dad said already, our sort of three-legged stool of our process, which we think is a good set of building blocks: technical analysis, fundamental analysis, and the macro environment. So just again for your review in the slide deck, some key things that we're looking at on a regular basis, and some of the charts that we'll share revolving around technical analysis are going to be, we'll see some things like the MACD and the price phase and the relative strength index. We'll talk about the breadth of the market. We'll talk about sentiment, and we'll talk about relative performance. And then fundamental analysis, really just a repeat of this CAN-SLIM acronym. That's again the cornerstone of sort of a broad, a really high level of looking at the fundamentals of a company. And William O'Neill, I think, actually, was more concerned with fundamentals than technicals, but obviously incorporated both throughout in his process. In the macro environment, one of the things that we like to look at is this 4-quadrant, a framework for macroeconomic analysis. And we're in this quad 4 sort of environment, although you could say quad 3. It's based on growth and inflation, the rate of change. The quad 4, we would see growth slowing and inflation decelerating. We have yet to see inflation decelerate, but the markets are clearly pricing this in. Oil hung on for a while until about a month ago, and so as we see commodities peak, we're probably going to be firmly in this sort of quad 4 environment of slowing growth, slowing inflation. And one reason why this is important to understand this environment is because, this is going to inform what the Fed is going to do. So if we can have a handle on what the macro environment is, we can understand when the Fed is likely to pivot, or when they're likely to I guess just change course in general. And along with that, based on some back tests, we can determine what's performed best in certain environments. Being here, we've seen the US dollar clearly being, an outperformer the last 6 months. Commodities, just since we've seen inflation accelerating, they've worked, but likely to stop working from here, especially as the Fed keeps putting on the brakes. Okay, so we'll go through some context here. We'll look at past bear markets for a good portion of this. Talk a little bit more about the Fed coming up too, and what's going to happen with rates, because that's just such an important part of what's going on in the market this year. So we shared this last month too. Just want to keep people reminded of the context. We're here at 168 days in this bear market based on the NASDAQ. That's that's not quite average. It's a little bit above the median. And the pullback is, now we're sitting here at 30%. It did reach 35%, which would be right on average. So it could be over if you're independent of a recession. But we think we're in a recession, so we'll talk a little bit about that as well. And even the Fed's forecasting it is talking about a recession now. They've caught up. And in more context here, I thought this was a great chart from Ned Davis Research, where they kind of show, and this is based on the Dow Jones Industrial Average. So notice how shallow the bear market has been in that. The bear market has really been concentrated early on in the NASDAQ, but some of these other names have held up, especially in those sectors that the Dow Jones would be concentrated in. So we've either got to extend this in length or see more of a correction. We don't think it's over, especially if this is a recessionary bear market. You'll notice the average recessionary bear market will see a 35% decline, and the average length is about a year. So we're less than halfway into this if it's a recessionary bear market on average, an average length, and we're far less than halfway as far as the correction. But again, this is the Dow Jones Industrial Average. The Nasdaq's already been hit much harder, and S&P as well.
Hey Wes, it's Larry. A question for you. We talked about last time, I think, what qualifies as we get into a bear market. What qualifies us to define that we're out of a bear market?
It's actually going up 20%, Larry. 20% from the bottom.
That's wow. Okay.
Right, and that's why this previous one is a little bit, it's an interesting chart because people think about the bear market of 2000 to 2002 as one thing, right? And here it's broken up into 5 because there were 20% bounces between each of these, subsequent or separate bear markets. Okay, and this is another chart just looking at what happens after we see a 2-quarter drop of over 20%, and these are the last, I guess, 6 times, 7 times this has happened, and post World War II for the S&P. And most of the time the market does work higher, 1, 3, 6, all these periods, right, for even up to 12 months, and it's significantly higher. But I guess it's yet to see what happens from here. But it does kind of lend some support to the fact that maybe we should be further along in the bear market than or there's less downside than upside. There's less to go on the downside, you would think, at this point, this far into it. Here's just another data point, another set of data points where we're looking at the annual returns and intra-year decline. So obviously there are pullbacks within every year. Our maximum pullback here was 24%, and we're down, it might be 18%. That might be a day or two old, somewhere around that range. And when we surpass that 20% level, you're less likely to see positive year-to-date returns, kind of looking at this chart. But there are some exceptions this year in the 90s with a 19% drawdown, and then ended up the year at 27%. But just another just some more context on what you typically see in a year. And this is looking at the Nasdaq cycle composite. So this is weighting a sort of typical year based on the seasonality of the Nasdaq, the 4-year presidential cycle, and the 10-year decennial cycle. And based on this cycle analysis, you suspect that you kind of retest the low in October, and you can be off to the races from there. There are some other things that we'll talk about here too, which could also support that idea of bottoming in the back half of the year. Okay, and this is one of those components of this prior chart, the 1-year or the 4-year presidential cycle. And so we're in the 2nd year of the presidential cycle, which based on their analysis here, it's typically a difficult year for the market, the 2nd year of presidency. And you can see that bottoming action sort of in that last quarter of the year, as well in this look at the cycle. Okay, so now we're going to look at a couple of comparisons. We're just trying to get a better get a better feel for what different bear markets it look like. Where could we be? Where could 2022 be? That looks like Susan. You got it? Okay. Yep. So we're going to look at this. So we'll show a couple of parallels, which just to to observe history and try to figure out where we might be this time. So here's the first look. This is compared to the 1962 bear market. And notice, the bottoming in June, a pretty sharp bear market rally and a retest in October. And again, just more of kind of what we were talking about with that cycle analysis too. So, this could be a, potential analog for what we might see this year.
Wes, let me step in for one moment as well. Now, the analogs that we're talking about, these are consistent with the 2 negative quarters, in a row. So those are the ones that we wanted to take a look at. So you'll see some of the charts, and we're comparing those periods of time that look most similarly like what has occurred in the past.
All right. Yeah. Oh. Here's another example with 1990. And we're trying to figure out, could we be here in this bear market where we've got this rally off the low, making a higher low here.
Hey,
Obviously,
buddy. That's my girl, son. That's my girl.
okay.
Who is that? And I will mute them. I don't know who it
Zoom
is.
user. Okay. So yeah, we're looking at this. Notice that what we've seen so often in this bear market is these quick distribution days following the follow through days, right? So we've had those quick reversals and quick undercuts of follow through days a number of times here. And the point of this is, if we are bottoming, we shouldn't see that immediate distribution. Dad, you said we did have that distribution today, right? In the S&P.
Yes, we had an S&P distribution day today.
Right. And this was a distribution day as well, right? 2 days following the follow through day. So it's not exactly, it's not a perfect comparison here, just because you really don't want to have immediate distribution. As soon as you do that, it's just less likely to be a successful follow through day. But still,
Actually, another question. Sorry to be such a pain.
Okay, no.
But last time we talked about a third leg down.
Yeah.
Are we going to? I mean, if we look at the 1990 chart, you really don't see that. I would include that dip that was in November as really that. So how does that play into what you're discussing?
Some of the upcoming charts, Larry, will show where we potentially might get that.
Right. This is just one example. It's just, I guess we kind of have an open mind here. This is probably the least like any of the other ones that we're going to look at as far as the other bottoms. 1962, here we are again. Notice this is when it officially becomes a bear market, down 20%. And then you have the sideways action for 5 months. So, Dad, I don't know, anything to add on 1962 here? Just your retest of the low in October, like we've talked about a few times.
Yeah, we had the political event was the Cuban Missile Crisis during that time. So there was a backdrop there politically.
1970, notice, again, this is the official bear market, down 20%. And here, in this instance, in 1970, we have that third leg down, and it's a pretty massive leg down. It's, I guess, another 20% in that capitulation, and that's what we've been talking about over and over again. So 1970 may be more of what we're looking for, I'd say this time. And that's kind of where, the title "Patience Prevails." We're having we're continuing to think that there's more risk to the downside for now. In 1974, a protracted bear market from the time it first hit a bear market, down 20%. Notice the close to a year in bottoming action in October, from November to October, a year later. Again, just another grinding bear market, which that could be the case this time. It could, it could grind along as the Fed just has to deal with inflation. And we haven't seen that capitulation action yet. We understand there's bearish sentiment, but but that can go on for a while. And we actually have another, I think, pretty good chart to show that, to show the last time bearish sentiment really persisted. All right, 2002. So this is another, a part of the bear market, or a separate bear market, just because there were those rallies, those sharp rallies throughout those 2 years. Notice officially a bear market here, down 20% from in the last leg here, and just choppiness for 9 months until you're in the clear. So it's just, it's hard to imagine that I think we've talked, it's hard to imagine another V bottom. We maybe have grown too accustomed to these V bottoms, where it goes straight up, and just thinking, the most recent real bear markets of 2022 and 2018. But we don't see a lot of that in these other historical examples.
This is also consistent with that third leg down, where you have the third leg down and the climactic action that might occur in a really brief period of time. That's why we think the CPI news, the backdrop, is so important. But the sentiment and the environment is so negative that we could bounce. But again, we think you sell the bounce, particularly in technology stocks. But this analog looks eerily similar to what we might expect, particularly if there's a bad CPI number. Well, it doesn't really matter what the number is. We know it's going to be over 8%, but it's how the market's going to view that number. But it's consistent with having a leg down, getting a reflex rally, and then a retest. And we actually had a similar type chart in 1998. I remember that clearly, but it was a little different. We were looking at a little different criteria. But this could go on for a little while, but there's going to be opportunities. We're just looking for that opportunity to add exposure when the market is distressed and it's, in its own sale. Until that happens, we're going to still remain pretty much 100% in cash.
Yep. Okay, 0809, getting the bear market just starting there in July, and I think most people will remember this, and again, a third leg, maybe in a fourth leg, I guess, in this one. And we know how that kind of evolved into a credit crisis. It's possible, we're looking at high yields. That's one of the things that we look at every day, is the high yield credit spreads, and those are clearly signaling extreme risk levels. The highest we've seen since, well, obviously 2020 in the pandemic, but before that, maybe 2018, we've surpassed that level, where the Fed did step in because credit markets were distressed at that point. So I'm pretty sure you can call credit markets distressed at this, and that's one of the risks. That's one of the risks that could also drive the third leg down in a recession, rising rates, and defaults.
And let me point out as well that on these charts, we're looking at the yellow line, which is the 50-day, and the red line is the 200-day. So from a shorter term perspective, we might look at the 10-day crossing the 21-day EMA, and the 21-day crossing the 50-day, and the 50-day crossing the 200-day, and so forth. But just to reduce a lot of clutter on the chart, we just have the 50-day and the 200-day on the chart. Really, the real trend doesn't change. We're in a stage 4 downtrend in the market currently. That trend doesn't change until we go back to build a stage 1 base, and then go back to a stage 2 uptrend. And Stan Weinstein, in his book, How to Secrets in Profiting in Bull and Bear Markets, I got that book, I believe, in the 70s or early 80s. And he goes through stage analysis, in which you go stocks base in stage 1. They're in an uptrend in stage 2. They top in stage 3, and they're in a decline in stage 4. And you really don't want to buy any stocks in a stage 4 decline. You want to be in a stage 2 uptrend. Now, what does that mean? A stage 2 uptrend occurs when primarily you've got to be 30% off the bottom. you've got to have you've got to be above the 50-day. The 50-day has to be over the 150-day. The 150-day moving average has to be over the 200-day moving average. And Mark Minervini actually he's added one more ingredient, that's a duration to the component, where he has a trend template on MarketSmith based on a 1 month, 200-day turning up and a 4 to 5 month turning up on the 200-day. When Wes will pull up in a few charts, and we'll look at the current a chart on both the S&P and the NASDAQ, we're in the slope of the moving averages are down. So you won't even know that you've got a bottom in unless those turn up for 1 to 4 months. I also like to look at closes above the 30-week moving average. So look at, and that's featured in Weinstein's book. So 2 closes above or below the 30-week moving average signifies a long-term trend change, the way that we evaluate the information.
All right, if we move on, here we are, 2022. So we just looked at the prior bear markets. And as we talked about this earlier today, these charts, we were talking about how, this bear market's very far to the right in this chart. And we saw a lot more unfolded as these bear markets sort of officially began on the left-hand side of the chart. So just, we could be early on in this, we could be mostly done, but, based on some of those other analogs, there could be some more work to do, some choppiness as well. Okay, so when we talk about the macro here, this is what, I think markets have been pricing in, right, for a while. And the Fed recently caught up, and notice that, a recession, we call that, or officially, right, it's 2 quarters of negative GDP growth. And so the last 3 observations, or the last 2, right, that we've seen, plus 6.9 and minus 1.6. And the Fed, the Atlanta Fed, finally revised their GDP forecast downward. This is as of July 8th. They dropped their forecast to minus 1.2%. So that would, officially put us in the definition of a recession, 2 straight quarters of decline. And this is something I found interesting too. They offer this movement, right? They show what's, how the forecast has changed, and they were calling for growth as late as really middle of June, even actually end of June, right? So they're, modest growth, end of June right here. And then I don't know what they saw in the next 7 days to cut their forecast, but that's something that we would have expected. It was kind of, they're sort of behind the curve on that, as evidenced by the market as well. And we got plenty of hints about the deteriorating macro environment as well. We got these company warnings and downward earnings revisions, and we'd expect more of these to come. But I just wanted to highlight a few of these that we've noticed and call out some. And what's interesting is the quickness that every company is saying. They notice this at rapidly. Target says trends have changed rapidly. Significant dislocation in sales and inventory from Bed Bath & Beyond. Pressures have materially escalated. So you're seeing this all across the retail space. You saw it from the semiconductors. Micron in particular warned, and then early on we had Microsoft who warned about the strong dollar, which is naturally it's a headwind to earnings when the dollar strengthens and you have international business. And then ServiceNow was on CNBC with an interview yesterday, I guess that was yesterday.
It was on last night with Jim Cramer, and they said that their sales cycle is lengthening. In other words, it's going to be, the quarters are going to be lumpy, they're going to be choppy, and they're probably giving, the market thinks that he's giving you the wink that they're going to miss and lower their numbers. We actually had the worst day since 2016 in service now today. Stock was down, I think 12% or more today.
Mhm.
And so that shows you also the enterprise group, enterprise software group, such as Microsoft Teams, a lot of the cloud stocks, they reacted dramatically today. Palo Alto Networks, Zscaler, Fortinet, and it looks like the slowdown is happening pretty quickly.
Hey, Roy.
Yes,
You're not surprised that more companies don't came out and pre-announced?
we are surprised. We're surprised that more companies did not come out. Yes, we are surprised, and that means if they didn't come out with, typically if you miss your earnings by 5 or 10%, you typically come out and warn. And I think if you don't warn like this, then there's going to be a brutal reaction to the quarter if you don't warn.
Yep.
Yeah, I kind of got me. I don't know what to think of that, because one thing, you're better is because they did pre-announce and then they get hit, then it's gonna come out that they should have pre-announced. But on the other sense, like, okay, they might not miss by that much, so it might not be as bad. So,
well, just what this certainly points out, it points out the difficulty in holding any stock into the number unless you have a cushion.
true that.
Right. Yeah, and so, okay, we're in the midst of a recession, and we think that's the case, and the forecasts show that now. But looking at this typical bottoming process in a recession, the market again is going to discount this, right? It's going to be ahead of that. So when the recession ends, and so if the market is bottoming, let's say today, then that means the recession, on average would last through another 4 months, right? So through the end of the year, almost at this point, if that's what you think, if you think the economy can pivot by next year or the beginning of next year, then you'd think that it's bottoming relatively soon here. So something to keep in mind. Just when the recession's in full swing, the market can still be bottoming for sure. And an interesting data point here, looking at the returns of the market versus in different kind of regimes of GDP growth, and you'll notice that the gains in the S&P are the best when growth is the worst. And a lot of that, it's not as commonplace, right? This is the biggest bucket, this 0.8% to 6.1%, sort of an average long-term growth rate, and you have modest gains in the market, 7.1%. But this is just reiterating that discounting mechanism. When growth is really bad, the market should see through that. Similarly, on the other end, when growth is extremely high, that's a market that's too hot. It's growth can't be sustained at that level, and we see through that too, or the markets do. So some other headwinds that we're talking about with the market, the real money supply, so just liquidity, excess liquidity being sucked out. There's the M2 money stock, the real M2 money stock. So adjusted for inflation is declining now. You can see other periods of that where it's turned negative as well. In the in the 70s and 80s, just as they were dealing with high inflation in that environment too. Okay, and then one of the hot topics, what are they going to do with all this inflation? And here's a path or the projected path of the Fed funds rate by the end of this year. It peaked at 3.8%, and we're just below that now. Our current target, we're here at 1.5 to 1.75%, and for now the consensus is they'll raise another 75 basis points. But I'd expect this this chart to move. I mean, it's got potential to move quite a bit following tomorrow's announcement, depending on where we are. Maybe I don't know. We'll have to see, but what that means. For now, just looking at the Fed funds rates into next year, so beyond December. We've actually, we start to see a peak in March of 2023. And then the futures are actually then projecting cuts at some point next year. So, maybe this is something to be aware of. The expected path of the Fed funds rate is obviously important. Just, that this is what the market is thinking for when they pivot. So I thought this was interesting to see that, obviously there's some faith in the Fed funds increase is actually being effective in combating.
And let me point out also, Wes, the risk in the market is the Fed is tightening as the economy is slowing. That's the worst possible time that you need to do that. But they're so far behind the curve, and they're just locked out. They must do it to get a grip on inflation. Remember, the Fed's target is 2%. So this isn't going to happen anytime soon. So for pundits that are very, very bullish, that think that the Fed is going to cut, that they're going to pause and cut, the numbers in Fed funds futures don't show that, in terms of where the market is pricing that. And that's why we think that the market is so vulnerable for that next third leg down as the economy weakens. Number cuts like ServiceNow continue to plague the market. Valuations are affected. Earnings go from $250 to $200. You put a 15 PE on that, and that's a 3,000 S&P target. So, if you recall, going through the 2007 to 2009 bear market, it just got worse and worse and worse. So we just don't know how the economy is going to react. And this could be a short, hopefully a short recession and have a soft landing, but the Fed's never gotten it right. And I really am expecting a hard landing eventually. And but remember, the market discounts that. So, so we are prepared to buy if there's a vicious capitulation cycle, we're prepared to buy because the market's going to be discounting that.
All right. So more about inflation here. And you got to wonder if the Fed is completely serious about it. They pivoted in the past. There's the risk that they pivot too early and inflation continues to plague the economy. The messaging has been pretty clear that they are not going to make the mistakes of the 70s. A couple of these, I guess, governors have talked about that, and Christopher Waller, Jerome Powell talks about that in his pressers so far the last few months, how strongly committed they are. And for now, it seems that the White House, Congress are not getting in the way of that. I think it's clearly, an issue for a lot of American households and everything. So for now, you like to see that they can actually do their job. And notice here in the 70s and early 80s, which is, I guess a somewhat comparable period where we've had this, haven't had this high of inflation in 40 years. The Fed funds rate gets significantly higher than the average inflation rate in 81 and 82. And that, I don't know if that's necessary this time around. The market is not pricing that in based on Fed funds futures. But they didn't take it seriously. The Fed funds rate was only moderately above the average inflation rate throughout the 70s. And inflation continued to be well above, I guess there was not a formal target, but well above that, I think, reasonable 2% target that exists now for a decade. So based on their messaging, they're not going to let up until there's really meaningful progress on inflation.
And that's what's startling as well. If this happens and inflation, we think inflation might might be at the 5% range by the end of the year. But if you're looking for a Fed funds rate target above the inflation rate, we just, the market would react. It would be a disaster if the Fed funds rate goes to 6%. From the current, we're at 1.5 to 1.75 right now, and the market's only pricing in 3. So anything can happen. We just have to see how the market reacts and how the consumer reacts and how the companies react based on the slowdown and the rise in rates.
Right. And one of the things we talked about too with that is, or I kind of think that we don't necessarily need that Fed funds rate this time around to exceed the inflation rate. We've got quantitative tightening, and there are some, I think, bad estimates out there, but like at least some estimates about what the effective increase in Fed funds rates is from quantitative tightening. And so, it could be an additional several percentage points. And so on top of the Fed funds rate being at 4%, maybe the effective tightening impact is really like 7%, which would then, could be above that inflation rate effectively. And okay, so in 2 weeks, we got the meeting. Right now, 75 basis points. That's the highest probability outcome. Again, something else you're definitely going to want to look at. You're going to want to check in the morning following that CPI report. I'm sure this has potential to move. I mean, there could be risk to 1 percentage point. I mean, if there's acceleration, I don't really see why they wouldn't similarly accelerate their trajectory of the Fed funds rate. So I'd be interested to see, if it is 8.8%, let's say the consensus, take a look and see if this becomes a much more likely scenario. Okay, and then here's just the rates, the Treasury rates, the 2 and 10 side by side. This is the effect of the policy, the effect of inflation happening here. And with that, we'll notice the yield curve inversion happening again. We had it for a couple of days back in April. It's recently inverted again, so that the 10-year yield is lower than the 2-year yield, and that's a well-known forecaster of a recession. It didn't forecast a recession this time if it was still not inverted to start the year, and we were in a recession in the first 2 quarters. It missed it. But this could signal more of a slowdown. And I think the 10-year, as it realizes that growth down the line is going to be slower, that's going to be more of a factor in that rate. While the 2-year is going to be much more directly impacted by the Fed path. You
don't see it on this chart, but we know what the chart looks like. If you look at the future yield curve, based on Fed funds futures, a year from now, there's a 66 basis point spread between those. That's the widest that it's been. And we most certainly are in a recession, or we will be going into a recession based on that dispersion looking forward on the yield curve, looking at the forward numbers.
Yeah.
Hey, Roy.
Yes.
I noticed the 2-year and the 30, the 2-year is getting real close to the 30 year. Do you make anything of that?
Markets, it's the market. It's becoming inverted on the short end, and then it's flattening on the intermediate to the long end. It really shows you recessionary fears. That's basically what it's showing you.
Right. Yeah. Agreed. Okay. So now we'll get to our sort of regular charts, and I'll cruise through these hopefully. But this is something we look at every day as well. It's the net long positioning of futures for the non-commercial. So this is the speculators. I just highlighted the most recent data point here that we're actually pretty net negative on the S&P and Russell futures. And it's a Z-score of almost 3x. So that's a very I guess extreme reading as far as the net short position in the S&P and the Russell. Interestingly, though, the NASDAQ is actually still net long based on these futures positioning. Okay, and so now we'll get to the regular charts in the S&P 500. We saw this low volume rally really the July 4th holiday, and now resuming the sell-off potentially here.
Notice the 2 distribution days after the follow through day. There was a distribution day, day 2, after the follow through day right there. And, you know, there's a 90% chance that the rally will fail when you get a distribution day 1 or 2 days after a follow through day. And then we had another distribution day today. As you can see, volume was higher than the day before. And so that doesn't, I mean, technically that we'll see what happens, but that's ominous action.
It is. And on the positive side, this is extremely low volume, you know,
Yeah.
still well below, but average.
Notice the NASDAQ too. Notice where the NASDAQ, where volume, look how light in the last 5 to 6, 7 days. When you look at the blue bars, it's way under average. So you're getting wedging action. So the market's moving up on lower volume on the NASDAQ. So that's not very positive either. Under, you know, when you're looking at things under the table with really what's going on.
Right.
Now that could change all tomorrow, of course.
Mm-hmm. Yep. And you know, if you look at that, go ahead.
Hey, can you go back to NASDAQ? So if you actually, yes, just looking at the chart, it doesn't look very positive. But if you, there is something called up volume and down volume.
Yeah.
The way you calculate it is on the day when the price is up, you take that volume over a period of time, and then you divide it by the volume with the down days. And if you look at that, then it is showing some positive action. Not very great, but some positive action, even though the volume is very low.
Well, we need something to build on for sure.
Yeah.
So.
Yeah. And we should add that. We'll maybe see what Stock Charts has for that up down volume, because that's something we don't regularly include in here. Thank you.
Thanks.
So, yep. More charts. FFTY, our growth names, really not getting much of a bounce with some of the other things like the S&P and the QQQ. Just continues to show weakness in the growth area. And along with that, the IBD fund, mutual fund index, you know, following that path, and a lot of these growth managers continuing just to struggle through this. And this is the percent change year to date. So actually, you know, off the highs, maybe add 5-10%, because these names, like, you know, are would have peaked somewhere around November of last year. All right, and we have the NASDAQ and the MACD. The MACD is technically on a buy signal here, but maybe rolling, on this next downward move. And this is interesting too. The NASDAQ never really has reached an oversold level. Early in the year it did, based on the RSI. So we're not, you know, we're nowhere near oversold at this point. You know, something to consider there. And here are the moving averages and the crossovers that we look at every day too. And the green and the magenta being the 10-day and the 21-day, and this being our main, I guess, consideration of an intermediate term trend. When the 10-day is below the 21-day, we're in that downtrend. And these last two bounces have been so weak, you haven't gotten that crossover. It's very close, right? In June, again, it was very close. This bounce too, but it's kept us out. It's kept us cautious. So the trend, you know, the trend remains down. It touched the 50-day, a declining 50-day. And, you know, that's all the rally could really make it to this time around.
Now, show the just to point out, we did have we had this trading rally. You can see there on the NASDAQ from the March bottom.
Mhm.
So you had this oversold trading rally, and actually we had something that's known as a power trend during that particular time, and you can see that we had crossovers to the upside, suggesting a trend change as well. And I believe we put 10 to 20% to work and got stopped out on that, within a week or so, as the market rode over and failed. And again, the market, the trend's been down since then. So the market hasn't given you any opportunity to get any traction. And it's very difficult to find leading stocks. There aren't any leading stocks. They constantly rotate. Again, the trend is still negative here. So, what would set the stage for an important bottom would be a capitulation event where the VIX spikes and the put call ratio spikes, and there's some panic, and we're almost there. We just don't see all the writing on the wall, and I think it's going to come based on technical things that happen in the market, maybe a black swan event, but there's no catalyst now. But remember, individual stocks always bottom before the leading stocks bottom before the averages bottom. But we think there's so much downside in the averages, and the big stocks such as Tesla and Google and Netflix and Facebook and Amazon and Apple, we think there's potential significant downside in that universe of stocks, while the next leading stocks won't make new lows. They'll be closer to making new highs. And that's the challenge for us as CanSlim investors, is to constantly work your screens so that you can find the next great growth stocks. So we're constantly looking at that and screening for those every day. And we'll talk about a few of those in the second half of the program.
Yep, that's right. And there are certainly some stocks that have fit that already, right? Where we think the bottom is in, and we'll just see if they can actually lead out of us, or out of the next out of the bear market. Okay, some breadth things that we're looking at, the S&P and percent above the 50-day. We saw that bottom out actually and recover quite a bit, close to 5%, and you can see that 5% level was hit in the last two bear markets, and something promising, I guess, to if that was washed out enough, potentially there. But the S&P and percent above the 200-day, not quite at really a super low level. Yeah, Larry.
Sorry to bug you again, but that last chart.
Yeah.
How important is that chart in the scheme of the charts that we're looking at? Because that, to me, says a lot. The fact that across the 0 point right there, like the blue line, like the other, the other bear markets or downturns or whatever you want to call them.
Right.
So maybe that's but if it's not a strong chart, then maybe we don't give it that much adherence. But that says a lot.
It does for sure.
Yeah, I don't want to skim over this. There's a lot of, and I don't know really what it means in the scheme of all the charts that we have.
Yeah, it's
Right.
important. It's important.
Mm-hmm.
It's obviously a positive divergence.
Mm-hmm. Yeah, and maybe we've kind of thought about looking at individual stocks more than the averages. So maybe you get this broader participation of the upside in a few of the I guess the old leaders that could weigh on things like Apple and Amazon and Microsoft that have held up the best, that can continue to hold up pretty well through this. So maybe we'll have some more names to choose from.
Yeah, because it's interesting. At least I'm just using my whoever we've got a lot of bottoming points here.
Absolutely.
But if you don't, just let me finish my thought and tell me if it makes any sense. Is that, to me, if you have a bottoming point, if it's not crossing the blue, you're not going to get a trend reversal. They all show little effects to the overall market, but it really doesn't change the direction until you cross the blue line.
We would agree with that.
So that's why this took me by, to me, this says volumes.
It does. Remember, it's anecdotal, its sentiment is anecdotal, breadth is anecdotal. So, but it's an important anecdotal aspect, I think, that's important to look at. That's why we have it.
Yeah.
Well done. Well said.
Yeah. All
Okay.
right. Thanks. Because the one that actually makes the most impact to me that doesn't cross the blue line is the 2018 November, because it came so close, but it still didn't change the overall effect.
And if you, this
until
is
you
the 50,
crossed.
yeah, this is the 50-day. I believe the next chart's the 200-day, Wes.
It is.
Okay, see, this suggests far more information, I think, and you can see how low it got in the 2020 bottom and the 19, and it got to the zero area in the 2007 to 2009 bear market and the 2000-2002 bear market. So we're not as oversold as it appears based on when you look at what happened in the 2020 market either. But again, this is just to give you some idea of context. And remember, the 200 days, longer term, and the 50-day, of course, is shorter term.
Right, but it's right on par with January 19.
Yeah, I mean, we're there's no doubt we're oversold, but in the other the ravaging bear markets that we've had in the past, it got to zero, Larry.
Just the one. Okay, all right, fair enough. Thank you.
Sure.
This is all about education, right? And
sure, absolutely. Yeah.
This just screamed at me. That's all.
This is important, and the reason we put this together is so that you can take a look at all these charts and make your own mind up based on context. So we want to provide all this information to help you, in terms of context.
Yep. And yeah, this is similarly, interesting that this is actually pretty good participation to hit that 38% level, but and it did hit single digits. You could say this is a positive divergence too, a small positive divergence, right? This higher low, higher high, while the market's making a lower low, right? So that's what you're, some of these things you're looking for. Two clues that maybe the under the surface things could be improving, despite the averages, continuing to get weighed down. In the looking at the 200-day, the longer term one, not as much of a recovery, but I guess that's likely or normal, because it's just going to take longer for that to change with a longer term average. But hovering near lows, what we've seen in the last two bear markets, and maybe next time I'll include 20 years. I'll see as long as I can go back, and that might, that would help even just to get us more and more context of
that would be great. Thank you.
So another measure of breadth here, the advanced decline line, and for the S&P, this is the S&P, right? So not a lot of extra information, I don't think, in this. It's just continuing to go sideways through 2022. I think the more interesting advanced decline is again the NASDAQ. Clearly in a downtrend on the advanced decline line, confirming the downtrend in the overall market here. And this is something we were calling out consistently in 2021, and what made it so difficult in the individual growth names is this, this sort of modestly downward sloping advanced decline line, while the averages continue to trek higher. And that just shows you the narrowness of that market of 2021. But this another thing we're looking for at the bottom. It's can this flatten out as well? Can it, if it can stop declining, that's the first step before we see a reversal in more participation. Okay, this is something we started looking at a lot too. The net new highs for another gauge of health of the market. It's hard to make money on the long side when you have net new lows, right? So this is the number of lows outpacing highs by quite a bit. That's been happening since November. So we know the NASDAQ itself peaked here in late November. And that's exactly when the net new lows started to outpace significantly here. And we've brought this out 5 years, so we can zoom out 5 years with this chart. And notice that it's about as bad as it was in 2020 as far as the net new low number, and it's been more consistent for these 7 months of net new lows. And it actually, the net new lows actually outpaced the 2018 bottom here. So just, another thing under the surface, we want to see blue start to come up above that. And right here, it was a pretty low number today, but we'll see if that can slow down, and we'll start to see some net new highs, and start taking more chances on the long side.
Yeah, Minervini calls this a hard penny environment. And this is a great chart because it shows what 20 years of that. And you can see really how devastating this bear market has been under the surface. And it's virtually impossible to make money when the number of new lows far exceed, and we're far exceeding new highs. The ratio is off the charts on the downside. So you can see this is a really useful chart because you can see how long it lasted in 2008 to 2009, the 2015, 16 bear market. But, we just need a cascade of blue to show when we see that happening, then game on the long side.
The VIX continues to, really not do much. It's getting above 30 a few times, right? And that's when we're seeing those steep sell-offs, quick sell-offs there. But then it's just coming in. It kind of looks like it could have hit support at that 200-day for the VIX here, but no massive spike here. Just kind of continuing volatility every few weeks or so. And that's one of the things we've been talking about too for months. We want to see that capitulation. We want to see a spike. We'd like to see something north of 40. We've said that a few times, north of 40. But for now, it's just there's no real fear. It doesn't, we're not seeing that in the numbers. We see it in the survey data, right? In the bear and bull survey data that we're looking at, but we still haven't seen it. So we'll see. We'll see if we get that moment, but I don't think no one's looking for the 80 mark. That was a unprecedented sort of event, but something north of 40 could be a signal of closer to capitulation. Okay, and then net active manager exposure, they're about 28% long apparently. So that is getting pretty low. You'll notice that at the COVID bottom down, I think it was about 5% there. So it's low, right? Active man, a lot of us on the call are barely long or short or altogether. So this is one indication, at least, where people with money are actually acting. Okay, and then as far as sentiment, we've talked about bulls and bears, and the bear number is elevated. Of course, that's a positive sign, right? A contrary positive sign when there's a lot of bears. But it's a poor timing tool, and we've seen that now, especially this time. We've been bearish for 6 months, and I think we'll see right here that the bears have outpaced the bulls since maybe December of last year. So it's been 7 months or 8 months of net bearishness. And so I highlighted that here on this chart this time, just to kind of get a sense of the size and why it's a poor timing tool, and how there was net bearishness for a year here, a year and a half almost, before there was that real capitulation event. And here, so that can persist. And if you look at the 1990, that was the other instance we found that was kind of a real long duration of net bearishness. And that's a pretty similar size. So we're getting up there to be the second longest sort of bearish period that we have on this chart. Okay, and this goes back similar to the VIX, where we've seen some spikes, we've seen some elevated levels of put to call ratio. So more puts being an increased amount of fear in the market. We've seen that spike twice now above that 1.15 level that we sort of look at. But you'll notice that at a few other of these instances with sharp pullbacks, it's gotten elevated to 1.3, 1.4. So, it's sort of, it's sending that mixed signal. There's bearish sentiment, but not a ton of acting on that fear at any extreme level. When we look at just the equity put call ratio, this is rising. That's kind of been an uptrend from the start of the year. And, at least that could help us put in a bottom, but it's been slow moving really throughout this year. Okay, and high yield spreads, we talked about this a little bit earlier, a signal of credit risk, a signal of recessionary risk and over leverage. And so this, this spiked quite a bit at the end of June, and it's come in since a little bit. But I think the important context here, I think the interesting context is looking at it a little bit more long term, and you'll notice here it's exceeded this 2018 level. And if we remember the 2018 level, I think this is largely why the Fed pivoted in 2018, right? So they saw credit markets in stress, and so clearly they're in stress, right? If they're using the same tools that they were, or they're the same diagnosis of the economy, they realize the credit market is in distress, but it's hard to imagine they can back off, right? The environment's totally different now. There was under 2% inflation in 2018. We're at 8%, so it just this uptrend is important to watch. A lot of times I've seen intra week, you'll see credit markets doing one thing, maybe selling off while the market rallies. So it's something to look at, because usually the credit markets are a little bit more sober as they look at as they price in new information versus equities. Okay, and FFTY we touched on earlier, our growth names, not getting much of a bounce, not participating much last week. The ARC funds, just continuing to show them they were the darlings of growth and kind of speculative names that still kind of plodding along the bottom here on a weekly basis, just to give some context about how precipitous that decline has been. And didn't quite undercut the low of COVID, but they've given back everything and then some since COVID. Bitcoin, always looking at that. I think last month I said this did look like capitulative to me, right? It looks a little different than the equity markets, this capitulation action. And it's held up a little bit since then. But we'll see. It's hard if things do get worse, this will probably go down in sympathy, but it's down 70-something%, so could be closer to a bottom, relatively closer to a bottom than some of the stocks. And Ethereum is looking similar, mirror image really, but the MACD on the bottom here showing some momentum improvement, but this latest move looks like it's going to have the MACD turning downward into a sell signal here, as momentum has waned over the last three days. So it's just, it's not going to be I guess a V bottom here, but continue to watch this, obviously just longer term thinking, and be patient. Gold, we'll touch on the sell-off. I mean, this is really just an inverse image of the US dollar of late. The dollar has gone parabolic straight up, and as a result, gold straight down. We had talked about this longer term monthly chart a number of months, I think now, but this fake breakout, reversal, and now a sell signal, really. I mean, to get out, there's certainly risk to the 50-month, but an interesting chart, a Brobdingnagian base here of 11-year base. But I always feel like I put too much time and effort into gold, and it never does what I expect, and it's not very volatile, so you don't get much, much juice from your squeeze there. Okay, and yeah, here's the U.S. dollar weekly basis. It's just gone straight up. It's kind of ridiculous. As the Fed has signaled their dedication to raising rates, and maybe some level of fear, as people run to the safe haven currency still. So that looks, I don't know. I don't know what to think about that. That looks extreme. But it's a core really allocation in these type of environments. So it makes sense.
It shows you the distress overseas as well. Remember, everything is translated into the dollar. So as good as the dollar's been here for our currency, you've got the opposite and inverse effect, and all the other in the EU and Germany and so forth.
Right.
So the economy is worldwide. We have a global economy, and it's just reflecting that the dollar is the best place to have your money in the world.
It still is. Yep, it's nice. Okay, and finally, you would have thought this U.S. dollar would have been weighing on commodities, right, the entire year. It just has not happened. It looks like this correlation has really gone to almost -1, I think, of late. So finally that strong dollar probably helping to put some pressure, some downward pressure on commodities. So crude breaking hard, big down day today. Oh, hold on, Larry.
Yeah.
Can you turn? Yeah.
Yeah, I am. I'm turning.
Okay, yeah.
Yeah, how's that? Better?
Yes.
All right. Because I was just thinking, whenever I see a parabolic move like that, you know that the bottom is just going to fall out of it at some point.
Yeah.
That's just what, Roy's been talking about ever since he's having these meetings about parabolic moves. And do we have any way of having any indication that is this going to just go to 108, or is it going to 180, given that the world is turning upside down?
We're not hearing you, Larry.
Turn left.
Really? All right. I thought it was right in front of me. Let me get. How's that?
Yes.
All right. So my question again was, do we have any indicators that we in any way know when this dollar is going to kind of reverse itself, or do we have to wait for the world to sort of heal itself as well to come back into more of a par? Because look what's happening with the euro. It's use the word par. It's now even. That's crazy, considering what it looked like a couple of years ago.
Well, do remember, when the economy gets better, or let me remind you that, this is putting pressure on, on U.S. companies that do business overseas. And, you're seeing all the currency translation adjustments right now. When the economy gets better and the dollar comes down and the Fed's done its duty and they've raised rates as much as they're going to raise rates, then expectations are going to come down. And when you see those expectations come down, and rates come down, then the dollar will be peaking. And so there's going to be a reversal, a change up that takes place, and it's going to help the equity markets. It's going to help the equity markets, but this is showing you the dollar's strong because rates are rising and real interest rates are higher here than anywhere in the world currently. So, you might watch that. The dollar's important. You might watch that for a reversal. That's going to probably help the equity markets.
Hey, Roy.
Yes.
Can I just go ahead and suggest that another reason why the dollar could reverse is if, in fact, we no longer become the reserve currency, we could have a very quick reversal, kind of like what has happened with oil. And
Right,
things
right.
like the Russian ruble and what China's doing, paying in rubles, that concerns me that is something that's a realistic possibility. What signs would we see that may be the reason why it's happening as opposed to your scenario?
Well, I don't think, I don't know what the reason might be, but it's important to know really not the why, but the when that occurs and what are the impact, what's going to be the impact when that happens. So I don't know why I don't know why or when, but I'm watching for a reversal there. There's it will show up in the markets, it'll show up in stocks.
Right. It will, but I don't know if I buy it because it's like, I don't know the alternative. If people would have said Bitcoin a year ago as they were, flying high above, getting rich on Bitcoin, but then that changed quickly. So I guess that's my hesitation is like, what's the alternative?
So I believe that once they move from the dollar to a basket of currencies as a reserve currency, this will have exact same effect that we had when we got out of gold standard. So essentially stock market will go crazy after that, gold will go higher after that, and Bitcoin may go higher after that as dollar will fall from that level, because then dollar will be considered in relation to the debt that the nation is having, and we have 23 trillion or whatever that number is, and it keeps growing every year. So that is the pain lying ahead of us.
Thank you for that input.
Okay, well, we saw the breakdown in crude. A couple of our members were, smart enough to get out near the top. Just, it's hard to overstay your welcome in this oil trade, and it was obviously getting crowded. And we never played the oil move in XLE, but this is, I think, one of the first things you got to see for a turn in Fed policy and a turn in the market, right? You have to see inflation start to slow, and I continue to think this is just a super important thing to monitor the price of crude. Natural gas also broken down from a month ago. You can look at a lot of different commodities. You can look at cotton. You can look at copper. You can look at silver, corn, soybeans. A lot of those, wheat, all breaking, all lower, and all kind of signaling that inflation probably has peaked. Even if the CPI comes in hot tomorrow, maybe it accelerated in June on that official basis, but this is one of these real-time things to look at just to know what might be happening in the future. I won't talk about these 2 and 10. We already touched on, and the 30-year looks really just like the 10, and the yield curve that we saw going negative or inverting. TLT, if rates have peaked, then this should work. We'll see if recession fears fuel the next move. It looks like it's trying to change in trend. You'll notice the 10-day here and the 21-day really on top of each other. So that's something we're looking at to qualify as a trend change. It's real close, and it's all it broke above that 50-day. It's working, trying to stay above the 50-day. We'll see. Okay, and then the last two things, just the credit ETFs, the junk ETFs. The inverse of that spread we were looking at, clearly showing some pressure in the credit markets, like we talked about. HYG and J and K being the best ETFs to watch for health and credit. And I think that's it. That is all we have today in our prepared slides.
Thank you, Wesley. Guys, let's take a 5-minute break, and then we will open the floor up for discussion, and also we'll pull up all the individual stocks that we want to go over. Wes and I, the meeting typically concludes at 9 p.m. but Wesley and I will stay as long as you want to stay online to discuss any stocks. And typically, this might be another hour or an hour and a half or so, because people really like to talk about individual stocks. But the meeting will officially conclude at 9 o'clock. Make sure that you responded to the link if you're not on our email list and you want to be on the email list. So let's take a 5-minute break.
Playing from desktop U8 NPB5V.
Let me. Where's that coming from? And I'll mute that person.
I think it's Silva. Silva, maybe.
Okay. Let me find it.
Just mute everyone, and then whoever wants to talk, they can unmute themselves.
That's what I'm looking for. I'm looking for the mute all. Oh, the mute all button.
Let's see.
Security.
Yeah, I wish I could help. I don't have the, I'm not an organizer for this, so.
Yeah, okay. Normally the person pops up on my screen. It shows who's talking, and then I can find them there, but I don't see it.
Yeah, it shows like a tone. And then,
You can also scroll all the way up on your participant list, and then you'll
Yes.
see whoever is unmuted, and then you can mute
Yeah,
anyone on that
that's
list.
what I'm looking at too, who's unmuted and who's not unmuted.
Okay. Yeah, I see what you're saying. Yep. Let me find it.
Mm-mm.
I think that was Alejandro.
Yeah.
Okay. Okay. Okay, guys, let me share my screen with you. We'll talk about individual stocks now. We'll open the floor up. I hope that you take time over the next few days to really sort of look at that slide deck, because that slide deck will provide you with a lot of information that we think is important in terms of where are we currently. And for everyone that's out there that says you can't call the bottom in the market, well, all market bottoms start with the follow through day. And O'Neill found that typically day 4 to day 7 was the window that the follow through days most frequently occurred and were right. Now, in the current bear market, we've had a number of follow through days that have failed. And Eric Kroll's research on the life cycle trade has done an extensive study, and he showed that when after the 3rd or 4th follow through day typically fails, that typically you have another couple of failed attempts before the market finally bottoms. So we're in this downtrend. We're in this stage 4 downtrend, but that's what we're looking for. And ideally, we're looking for a panic climactic type of bottom, and the market rally off that bottom, and you put in a decisive follow through day. So day 4 to day 7 off the bottom is what we're looking for. And so those are the clues that might suggest that a bottom is in. Or we could just grind, we could grind lower, we could grind sideways, but we provided a couple of analogs that I think are useful. And these analogs just provide they provide you a look at what other bear market bottoms have, what they look like. So to us, it doesn't look like the bear market is over, and we don't believe in buying and holding and just riding it out either. We believe that there's a time to decisively be out of the market and can stay on top of things because things change rapidly. But, if you rode the market down from 2000 to 2002, you got obliterated. From 2007 to 2009, you were eviscerated. And we want to make sure that that you don't get into the fetal position here, because we don't know how bad this bear market is going to get. And what's different is, and I recall the 2018 bear market and the 1998, 2002, you had stocks to buy. And we don't have a plethora of stocks to buy. The market's rotating. The only leadership group right now is biotechs. And energy stocks were the last stocks that were leading, and they got hosed as oil prices dropped. And that's what we were afraid of, is that if you had a breakthrough in Ukraine and Russia, you would have a similar type of drop, and in the portfolio, those stocks would drop 30%, and they did. Most of the energy stocks are down 30 to 35% off the top. So I do have a presentation at Trader Lion that I'm presenting at 9 a.m. next Sunday. And I'll talk about a lot of stocks, a lot of things that we talked about tonight, but I'll also talk about finding the next great growth stocks. And for us, we use MarketSmith. So MarketSmith provides us all the tools that are necessary to screen and find those stocks. But that's just part of the process. If there aren't any stocks, there's really not a lot to do. But once you find them, then it's all about executing your strategy. So let's take a look at some of the leaders out there, and then we'll open the floor up. So there are only a few stocks. Let me share my screen, by the way. Now, what makes this so hard is these are crowded trades. See, everyone that follows, CanSlim and follows growth stocks, they're looking at the same stocks. So you're looking at the same stocks. It's a crowded trade, and they can pull the rug out from underneath you at any point. But LNTH is one of the few stocks that's got triple-digit revenue and triple-digit earnings growth. And you can see that they reported earnings up 999% last quarter. Revenues were up 126%. You can see the stock is close to being in new high territory. The stock broke this down trend line 3 days ago, only to be rejected because of the market environment. But this is one of those stocks that's shown power blasting out of the base on an earnings report. So remember, this is one of the key principles and criteria. If you can find a stock that goes up 10% in price that day, where volume's up 300% higher than normal, at a new high, preferably on the earnings report, that should provide new leadership. So we're about to get into earnings season, and so you're going to have to watch this closely to find out what stocks actually perk up here. So this company makes a medical imaging agent. So they just came out with a prostate product that they're using to inject the patient, so that you can see, you can detect prostate cancer more readily. And you had a great fundamental change where revenues grew from 129 million to 200 million. So anytime you get powerful revenue growth like that, quarter to quarter of organic growth, and that's not them buying another company, that's a new product. That's why that establishes clearly the N in CanSlim. So this is one of the leading stocks out there. You can see that it's just going sideways. If you take some pressure off the market, say the market rallies, and this is, if you break this downtrend and take out the high of 2 days ago, then that would be a place to add to a place to buy the stock if you're not in the stock, and press it all the way up to 73, 78. So you have a decisive pivot point right there 2 days ago, and then you would look to have your total position established at 73.78. And you can see that earnings are expected on 7/28. So you do have that risk of earnings going out in a few weeks. So I definitely would not buy the stock right here going into the number. But if the market turns, you have an opportunity to add to the position. Does anyone have any comments on LNTH or who's in this stock currently? No comments on LNTH?
I got stopped out of it.
And when did you get stopped out of it? When did you?
Oh, that was back when it was choppy over in June.
In June. Okay, so it made that new high right there. Yeah, on that when it made a new high and then came in, correct?
No, I tried to get it after the correction, thinking it hadn't been tightening up long enough, and I just got moved around and lost it.
Yeah, this is. This is the leading growth stock in the market. We've talked about it the last two meetings, but look at this choppy action. See, that's acting abnormal, and I got stopped out of it as well. Either on I had it in my trading account either right off the top or the second day, the first or second day, when it reversed and showed that extreme volatility. But it is tightening up now, so it's tightening up, and it looks fine. As you look at it on the weekly, and again, if you take out that weekly pivot, right there, and it could certainly become it's certainly the leader in the marketplace right now. I would definitely have my eyes peeled on this one. This would be one of the top stocks that I would go to if the market reverses and we have a powerful blast off day.
Hey, Roy, I had
Yes.
a quick question. This is Dan.
Hey, Dan.
This is my second meetup with you guys, so thank you very
Okay.
much.
You're welcome.
How do you evaluate some of those moves like that with a backdrop of the market? But I've seen as a basic, say like a template, when you come out of those bases, and this one's up about 115%, and you get into that 80, 120% move off a pivot, but you don't get another base yet, that typically sometimes it needs one more, right? Or something else to kind of anchor to before it just might go up,
Well,
to a new high.
Yeah. And that's what it's putting in the base right now, but the base is flawed. The base is, you've got a flawed base there. And I was trying to count the weeks here on the weekly. See this base 1, 2, 3, 4, 5, 6, really solid base would be 7 weeks. And particularly if it's trying to put in this cup and handle formation, I'd like to see a 7-week time frame, and we're at 6 weeks right now. So it just might not be, the timing might not be right, right now. But remember, great leading stocks typically have 8 earnings beats. Like and that's about 93 weeks. And this stock clearly has a lot more runway to go, but it all is going to be predicated on how the product that they're selling, how that's doing. And what I like about it is it's not, they doubled their revenues in the last 3 months. So it wasn't impacted by the economy. It wasn't impacted by any of these ancillary factors. So it's flawed a little bit, but it's got a 99 relative strength. The relative strength line's at a new high. And it's also got this earnings per share rank, guys. And one of my favorite earnings per share screens that's not in IBD, I run this 70 to 79 EPS and relative strength over 85. And that'll get you some leaders that aren't in the IBD 50 or the market growth, Market Smith 250 or the weekly review. And you can see these are the stocks that are showing up there. So, I learned this way back in 1990 when a man by the name of Norman Yu was managing my managed accounts, and he and a lot of his stocks didn't qualify for strictly can slam like this, because this had a 70, I think a 75 earnings per share rank. And so so I put that in my screening methodology. And so you have United Therapeutics, which is clearly one of the leaders in the market right now. You've got some oil stocks. This Celsius Holdings is showing up there, which again has triple digit revenues and earnings growth. You've got some oil stocks that are there. And I'm looking primarily for growth. And so when I go through these names, this RCMT is a thin stock, but it's got some numbers. There's EVH, Evolent Health. And so a number of these aren't going to show up in your Market Smith screens unless you screen for them. Okay. So another leader would be this Celsius. Now these are crowded trades. So everybody's in these. And we're just waiting for the market environment to either improve. We almost bought a token in it in the last couple of weeks when it broke above the 200-day moving average, but it's got a relative strength of 96. And look at the earnings growth, 800%, 650%, and revenue growth in triple digits. When I didn't mention, but I met David Ryan and Bill O'Neill in 1988 at a seminar, and that really changed my life in terms of knowing what to look for. And David Ryan was his protege, and he won the U.S. Trading Championship for 3 consecutive years, averaging over 150%. And I wanted to find out, well, how is this guy doing it? What is this guy doing? And that's where I became acquainted with those guys. And that's where I began my love fest with Investors Business Daily and the methodology. And David told me before at one of the seminars that I attended 25 years ago that he got some of his biggest winners with stocks that had a 99 earnings per share rank and a 99 relative strength rank. And those are few and far between. But so I've always looked at that. But look at Celsius, see with the 76 earnings per share rank, but it qualifies, it's got over an 85 relative strength. And it's got these triple digit numbers. Right. So look at the pivot where it broke the pivot. You can see this clear pivot at 72.01 where people bought it and they got shaken out of the stock today. So typically when you break out, you don't want to see the stock come back into the pivot. So it did hold the 10-day, but if it comes, if the market gets hit, it will be a failed breakout. So it's right on the cusp right now.
So Roy, this is a perfect example of Wyckoff candidate. It will probably come down a little bit and then move up higher from here. And the possible target from PNF perspective is 100 to 110. Yeah. And this is all characteristic of Wyckoff actually.
Yes. Yeah. And so, this is springing off the bottom. There's your point of support. And this is just really a natural reaction that it's going through. So, a lot of this action is going to be predicated, whether or not it's going to be a winner will be, there'll be some impact in the market. But look at the numbers this year and next year. And this, LNTH, CLH, and SWAV are the 3 stocks that have these types of numbers that can provide leadership characteristics. And we're not talking about a trade for, 10 or 20%. I'm looking for stocks that can double and triple over the next bull market. And they've got earnings projections of up 120% next year. So, pay attention to that. That's a huge number. So ideally, you'd love for the stock to come in, the market to bottom, it turn up, stay above the 21-day, add a little bit, let it tighten up, and then press the position going over $80. You want to add on strength, not weakness. You want to average up into the position because if, this market is clearly showing you that it's a bottoming action. So you can clearly see that even if the market goes lower, CELH bottomed 2 months ago. And so that's really what, it's setting itself apart in terms of leadership. It's finally getting back over the 200 days, building a base, it's turning up. So you definitely want to be watching this stock. And then SWAV was a little bit sloppy. It's sort of the same setup. They make a device to using sound waves to reduce calcium in the heart, to break calcium up. And you can see I've got a trend line drawn here, and they've also got triple digit numbers. So they have very solid revenue growth, 55 million, 65 million, 84 million to 93 million. Notice the volume, the biggest volume, and that was up volume at the bottom. And that was only a couple of weeks ago. So don't worry. I don't have any FOMO whatsoever about not buying this stock at the bottom. I'm looking for not the absolute the bottom, but the perfect time to buy it. And if you're looking for a stock to rise 93 weeks, then it's just getting out of the gate here. But look at the numbers from the revenue side. Up 194%, 270%, 230, and there's great earnings growth. So you've got earnings growth too, again, that are organic, and it's not. It doesn't have to do with the transaction. It doesn't have to do with buybacks. It's organic growth, and it's a mid-cap stock, but it's also on everyone's watch list as well.
Roy,
If
Yeah.
you go to the weekly chart,
Absolutely.
will this be a W pattern?
There's the double bottom. Your double bottom is from the top coming in, undercutting it, and there's your really breakout right there, and that failed. So, there's your undercut, there's the double. Then the breakout, your buy signal was taking out the midpoint in the W, and then it rode over and failed. So it's just really just a staggered base, but you can draw a trend line right there so you can see that if it breaks this trend line on the weekly, that would be an early entry point. So if and by the way, we in our disclaimer, be aware that these aren't any investment decisions. This is for educational support only. But that would be an early entry if it broke this downtrend line on the weekly, right there. But remember, CanSlim guys, that William O'Neill's studies of all the great market winners, most of the stocks have. They require a 25% earnings growth rate and a quarterly increase of 25% as well. I've always found that the ones that have the highest octane, the big winners, they have triple digit numbers. So all my attention is focused. I'm watching these stocks just like everyone else is. Notice the quality mutual fund exposure. So you have the top mutual funds out there that are in growth, and these are part of that mutual fund index that the top 20 mutual funds that Bill O'Neill used to like to follow from growth, everyone from Fidelity to T. Rowe Price. And so this is your confirmation that people like it. So that's part of the I in CanSlim. You want institutional coverage. And you can see the institutions are raising their exposure to this stock. Notice
Roy?
Next year, earnings are going to be up 47% next year. Yeah, go ahead.
Should we make anything of the fact that it's pharmaceutical companies and biotech that's setting up? Is that like cycle work says that that's what's supposed to happen, or is it just stock traveling?
It's not in, Dana, it's not in the biotech group. It's in the medical systems group, which is moving up on the charts. And as well as the biotech stocks that are moving up in the charts as well. So those are moving up. And, ideally you want to be buying in the top 40 industry groups. And so this is 47 right now in the medical systems group, but it's moving up. So this is how new leadership arises. And so it's definitely moving in the right direction. And who else is in this list? Let me see that's in growth. Well, there's UTHR. This is one of my favorite stocks. This stock was down, I think, $8 today and closed way off the bottom, hit the 21-day, bounced. And this is one of the leading stocks in the biotech area. You can see the medical biotech. It's number 21 currently. And this group has had an amazing resurgence since the market bottom. But look at how choppy. I mean, look at how choppy this stock was. It missed the earnings estimates. It got obliterated. Look at this up and down action. Now, then the stock went up on a new product launch. Look how choppy this is. There has not been any place that you could legitimately buy this safely. You know, you had an opportunity coming into the 21-day and it held, but this is just, it's all over the place. And then earnings are due in a month. But this is one of the leading stocks, you know, in the market today as well. Solid numbers, 44% earnings growth, 22%. This is the last bastion really in terms of growth. These are the holdouts. So it's going to be interesting to see if biotech hangs in here right now, or if it comes under pressure like the energy stocks. This is another favorite, guys, Vertex. So you can see Vertex breaking the downtrend line, and you can see where it's building a base, going sideways. Nice, you're at a nice price point, $290, 98 relative strength. But the numbers aren't that impressive when you look at the annual numbers, 9% this year, 7% next year. Granted, they have had some recent quarters of 20%, but they're, you know, that's not really knocking the socks off when, you know, when in terms of you looking at the numbers.
There's a new issue, Procept Bio. That one's like ablation for prostate, but it still looks choppy.
This one right here.
Yep.
So, and you know, what I do like about these IPOs is see the new leader, man, it's choppy, the pattern, look at this. And this is really what's happened. See where it broke, see where I had the trend line drawn at 40.69. See, in a good market, it would have stuck and it gave it all back. You got stopped out. And time after time after time, we've had this type of setup only to be negated because the market's not ready.
So what do you look for a constructive setup?
Where do I look at what?
For a constructive setup, for this to set up right? Well,
it's got to be, this stock has got to be above the 50-day. The 10 days got to be above the 21-day. And you can see the 10 days below the 21-day and it's below the 50-day. I wouldn't buy a stock that's below the 50-day here.
Have you had a chance to look at AbbVie, ABBV?
I have looked at it and it looks, you can see I just draw a somewhat false downtrend line here. And it's got the same type, you know, look at the growth, medical ethical drugs, group 17. See, this is what you want. You know, you want this tight action, see, from November to March, and then, you know, then it's rolled over. But we're looking for an action, you know, when the stocks are going, you know, when it's, look at where the stock made a new high in December, and then how tight it was as you had that nice base that lasted for about 5 months. You know, it's tightening up right here. But, you know, again, the numbers, look at the numbers, $14 this year, $12 next year. Earnings going to be down 14%. But this is where, but people that are chasing growth, you know, and you have a lot of, you know, you have plenty of guys that are just buying growth stocks, and this is on their list as well, you know. There's another, well, there's Aspen Technology. That's in the wrong group. That just, this looks like a short. Look at that, just breaking the 50-day right here in the the computer software enterprise area. That's what a good short looks like, guys, right there. I was looking, there was, I think, let me see if this, no, there was there's another biotech that I was looking at.
AZN, AstraZeneca.
Okay, that's what I was looking for. Okay, this is, no, look at this great double bottom base. So there's your double bottom base. And, you know, Market Smith, what's nice is you've got pattern recognition here. So you can see a lot of these charts. So you've got a double bottom base set up. And now you've got a sideways handle that's looking quite constructive. And this company has really great numbers. Look at the setup here. Earnings are going to be up 34% this year, 17% next year. They're going to increase. And look at the recent revenue and earnings growth, 50% revenue growth and very solid earnings growth. And so this is setting up with the 93 relative strength. This really looks promising to me. Let's pull up the market growth 250. So the market growth 250 is comprised of about 30 screens that Mike Webster actually designed this for Bill O'Neill. And it's really quite good. And you're going to find most of the market leaders on this, either on the Market Smith Growth 250, the stocks that have relative strength lines making new highs, the stocks that are breaking out to new highs, the stocks that are on the IBD 50 list, and stocks that are going to be on the IBD 85 list, and that's the weekend review. You're going to get most of these. So you can see energy has been a top group. Notice how they came after solar. Solar was one of the leading groups only for a couple of days until a couple of days ago. And look how these got obliterated today. And so you had, these were the three leaders, Enphase, DQ, and JKS. And I suppose that with oil prices dropping, potential solar demand might be off. But look at how it broke the downtrend line, setting up, had great numbers. I mean, these numbers are out of sight, but then it failed. So you've got a failed breakout right there. So it just needs more time. And of course, that pattern is structurally flawed. But look at
it looks like these people are getting caught in these stage one or these bases, and they're trying to buy breakouts, but it's still stuck within the base with a 200-day that's flat. People are trying to get in too early.
Yep, I agree. Yep. And you do, there's that, let's look at a couple of points that you just made. So the 200-day is still flat, but it's above the 200-day and the 10 days above the 21, like back in here. But then you had abnormal action where you got shot. Most traders are going to sell if it breaks the 21-day for 2 times. You actually you got stopped out here. Then you got moved right back in. I mean, this is like a roller coaster, up, down. It's not, solid, but you just need more, you probably need more time, but you've got a really good relative strength rating and line, but the markets, you can see up here, the market's under pressure. So we're just quite not ready, but look how many great funds are in this stock.
Hey, Roy, I have a question for you.
Yeah.
I know that the old market leaders usually aren't the new market leaders after a correction, but with Amazon and Google and Facebook down so much, should we just give up on those, or are they going to be a value play at some point?
And I think they've peaked. And I think what you have to, I will make the point. Let me make the point that, these stocks, if you take a look at Microsoft back in 2000, and Microsoft had one of the largest moves in history for the decade. And and I crushed it back here from 1998 to 2000 in Microsoft, but it had like a 10-year run. Just like Amgen did, just like Home Depot did. But look at when it peaked at the top. Microsoft, it was still one of the greatest stocks on the planet, but it took you 16 years to get even. And look at Cisco Systems. So prior winners, Cisco Systems, when it peaked in 2000, and this is a stock that went up like 30-fold in 5 years at the top. And look, this stock hasn't made a new high in 22 years. So it's rare that you get a Tesla that actually was a leading stock for a market cycle, came in, and then it had the incredible run that it had again. But that's very rare for that to happen. But I think, why not? I mean, I think you can make the case, and let me see if I can. The Qs went up for 13 straight years. And I think that, Google is still a great company, but the numbers are softening and declining. Apple has no growth to speak of, but this is what happened in the Qs. When the Qs peaked in 2000, then it took you 16 years to get even. So you have to be careful coming in here and buying Google after a massive move you can see the move from Google from the bottom in 2008. This is a character change. And if you look at Google, take a look at Google's numbers. Well, decent numbers. They're going to be up 10% this year, supposedly 19%. But again, if we go into a recession, these numbers are inflated. And look how poor the relative strength is, 57. It's below all the averages in a downtrend. So you're not going to have the beginning of a new uptrend till you take out that 2386 level right there. And it's going to be interesting to see if you make another leg lower or if it holds in here and it turns. There's Apple, but look at Apple's growth, guys. 9% this year, 7% next year. I'm not going to buy a stock with 9% earnings growth and 7% earnings growth. I want something that's got triple-digit earnings and revenue growth. This has seen its day in terms of, how hard this is going to be for this stock to double from here, from a market cap, the market cap that it is. It's going to be very difficult for this stock to double. And it's just been a place to hide because it's, quote, a safe stock. But if that's you have to be prepared that when the cycle turns, and look at Apple, look at how many times it hit the 50-month. And this is the magenta line. So from the bottom, the last 15 years, when the stock corrected, it hit the magenta line. 1, 2, 3, 4. And if it hits the magenta line, I saw my buddy John Roke sent a piece out to me today that he wrote for 22V Research. And he's got a price target of $100 in Apple. That's the 50-month, $99.
Yeah.
So there's your downside if the hits the fan and they come and get these stocks, the stocks that only have 9% growth, 7% growth with the PE of 24, and then earnings are coming out in 16 days. And if the consumer is slowing the way we think the consumer is slowing, who wants to buy a $1,200 phone and get upgraded?
Right. Okay, thanks.
Yeah, I would say the best case scenario for these Apple, Microsoft, and Google is they don't have to lead. They're not going to lead, but if they can just go sideways and we have new leaders, that'd be the ideal situation. Because unfortunately, if these keep going down, there's such a heavy weighting on the NASDAQ that NASDAQ most likely will go down too.
See, that's what that is what I'm. And Wes and I, we've talked about this for quite some time now. You know, if ideally they come and get Microsoft, it goes to 200. And look, there's going to be some panic in the streets if that happens, particularly if it happens quickly, like in the next 30 days or so. I mean, it's possible that, I mean, I think we're going to we're in the midst of putting in a bottom. We just need some climactic activity, and the fireworks are going to start tomorrow. And then you've got a lot of these big cap tech stocks that are reporting next week. And then you've got the Fed meeting, then you have the GDP meeting. So you've got a lot of information. And, you know, Minervini does say it best. He's not even looking at the indexes, but 3 out of 4 stocks go down when the indexes are in a downtrend. So I don't mind missing the first move of a new market leader, like, you know, if CLH is there or SWAV or LNTH, you know, if they're going to go up, you know, 150 to 200%, if the market's under severe stress. But there's the 50-month that I'm targeting. So that suggests a $200 price right there in Microsoft. And there's Tesla. So the 50-month on Tesla is 400. So, you know, you're not going to have a lot of people out there that are suggesting that Tesla's going to 400, but based on cycle work that I've done and based on looking at all these leading stocks, this really is my favorite short candidate out there, because I think they're going to miss the quarter. And I think it's, you know, this has been the most loved growth stock out there, and it's going to roll just the way where all these leaders roll. They eventually get them. Look at when it broke the 10 months. See, so it's living below the 10 month. It's definitely should not be held unless you bought it, you know, a long time ago and you have a big tax gain. But
I guess a good example what could happen is Netflix, right? Like,
yep. Well, look,
you're gonna tell that.
So look at when Teladoc broke the 10 month. So it broke the 10 months, and then you had just a I don't know, what do you call this? This is the biggest waterfall I've ever seen. But there's the target to the 50 months. See, it hit the 50 months. So, you know, Zoom did it. Zoom hadn't traded long enough to have 50 months, but that's why you have to be careful. And we don't know how bad this bear market is going to be, but I see a little bit of green shoots, but you've got to be careful, because we don't know how bad the economy is going to get. And there's not plenty of stocks to buy. Bill O'Neill many times talked about leading groups like retail. That's normally a great place to where you have some big winners, but you want to see like 30 or 40 stocks break out in an industry group. And we don't have anything like that. So there's no leadership. Here is the 52-week high list today. I mean, look at these names. So these are the stocks. Now, this stock looks interesting. It's a tiny stock, SWIR. It's definitely a leader. But look at who are these stocks? Nortech Systems, Alpha Star Acquisition, Data Knights. These are SPAC. Those are SPACs. These are SPACs. This is just junk. And so this is your new high list, which is this Target Hospitality is that's popped up. It's a cheap stock that for wedding planning and things like that, event hosting, and that did hit the screens with volume, and somewhat of a defensive play, but this has popped up on great volume here, so that is something to watch, but it is somewhat defensive. And this Sierra Wireless that popped up on the new high list has great action, but let me pull it up here. So this stock actually broke to new highs today, and they have decent numbers and great relative strength. It fits, it's in that category, see where I talked about 70 to 79 earnings per share rank. So it's hit that screen. And so this is on my watch list, but it's, look at the market cap, less than $1 billion. You know, it's not very liquid. So here's the, again, the Market Smith Growth 250. So you're looking for growth. You have all these oil and gas stocks, and I think you're going to have a reflex bounce. So there is a trade, you know, there's a trade for an oversold bounce when energy bottoms and bounces, but it's a trade, and then they're going to potentially make double tops into the number. But, you know, look at over here, the industry groups, you know, you don't want any insurance and property and casualty stocks. The HMOs are defensive. That's where people are hiding. They're hiding in these discount variety stocks like Dollar General and Dollar Tree. So discount stock, look at this break. Like, so, I mean, how do you buy this? You know, it's just, look at that. You stock broke out to a new high, came into the 50-day, and then it exploded. Then you had this big reversal, and then, you know, that's not buyable. I mean, I'm not looking for stocks like that, but this is a place where people are hiding. So we don't, yeah, go ahead.
I just wanted to look at a stock if I could, if you.
Yeah, go ahead. Yeah,
yeah,
absolutely.
Yeah, DLR. So I'm looking, this is a bearish trade, and I just wanted to kind of see their numbers there. This is brought to my attention by Jim Chanos. So this company, and what they do is like data centers, but it's like the legacy brick and mortar.
Yes.
So, you know, obviously competitions like, you know, Google Cloud and, you know, Amazon Web Services. So
yes,
it has that big support at that kind of that 124, and it broke it today, but then kind of closed above it. So I have puts, I have long-term puts on this thing. And I wanted to see their earnings there. So it looks like 0.74, and next year 7%. Okay.
I mean, those numbers are, I mean, this is really a bearish chart now. You know, the break, the move back up to the 200-day, the consolidation here, the move back up to the 50, and now it's turning down. Now it's, you know, if you get this undercut, you know, a lot of times you get that undercut and rally set up.
Right.
So you've got to be aware of that, but you do have decided support that may break to make the next leg lower as well. So it's, you know, and, you know, he believes that he's got like 3 of them that he's short.
Right.
Who are the other ones?
I know the other one is EQIX, I believe.
Oh yeah, EQIX. So this is, I mean, this could definitely make, you know, the next leg lower. This isn't a cheap stock. Look at the revenues. They're doing 4 billion. So the price to sales is 10 with negative growth. This is this really is the kind of stuff that's risky, you know, in this market environment.
Yeah, so what I did, I bought puts for October expiration. And then if it can't break this 124, then I'm going to sell puts. So if there's going to be chop, and then I'll like at least get a little bit of money back on that. But I have October expiration. So, I mean, it looked really, really good today. I thought it was going to close below 124, but it broke it and then came right back up. So we'll see.
So, I mean, tomorrow is it's an important day. You know, tomorrow you either cover or you can make money. Like, it's, you know, it's about to implode. So tomorrow's going to be, and this is the same way. This is a very bearish chart.
Yeah.
You know, same kind of thing, 7%, 9%. And what's that look like on the monthly? So it's been, it's been a place where, it's been in this nice uptrend. These REITs pay, quote, a dividend. And that's what's keeping people in them or the dividend. But, the growth is anemic, really. So you've got the same type of setup. It's a bearish chart.
Right. And I like because their earnings are just lower and lower. It leads on this every quarter for the most part. So, I mean, I think everything sets up pretty well. Just kind of a matter of time and see if it kind of breaks these levels and go from there. Yeah.
Right.
Hey, Roy, do you mind looking at a weekly on Grocery Outlet? It's GO. The earnings aren't great, but it's had an impressive month.
That's it's on everyone's screens, Vaughn.
Oh, is it really?
Yeah, I mean, people are aware of it. So you've got, it's grocery store, discount grocery stores. Like here in Charlotte, we have a Trader Joe's.
Yeah.
Which is a great place to shop, and discount grocery store with a lot of their on-branded merchandise. And I think this store has the same type of attitude, awareness. Yeah. So, well-run grocery outlet, sort of like a boutique. And I've only heard good things about it. And look at the, look at the relative strength, but the numbers, look at the earnings numbers, they're
bad. Yeah.
They're bad, and the revenue growth is not, this has just been a place to hide, but yeah. I think it's a well-run outfit, but the numbers aren't impressive.
Yeah. Thank you.
I think this is what you would call a scalper's market.
Oh, definitely.
What's that, Joseph?
This is a scalper's market.
Man, it is.
Over the past month, I've tried trades. I get up 5% just to get stopped out, break even the next day. It's not even worth the mental capital at this point. I'd rather just wait for we'll see what the number is tomorrow, but wait for the moving averages to curl up. If you study the 2020 bear market, you'll see stocks, the leaders, some broke out before the market bottom, some broke out after,
Yeah. We just, the screens that are run with high earnings growth, Joe, they're few and far between. I mean, the list is not very long, and they're just, but I'm seeing growth in this biotech area. See, the group is 25 now, and you can a lot of people like this Halo and also Harmony Biosciences as well. And in fact, Mike Santolo of Cabot he's 85% in cash, and he just bought this one, HALO. And I really follow his work. But Ropel knows about it. I mean, everybody knows about these, about the same companies. I actually bought Harmony for our clients back here in March, April, and got kicked out of it. And look, what impressed me about it were the numbers. Earnings growth, 89%, 152%, 100%. Revenue growth of 43%, 62, 77. These are the numbers. This is where leaders come from. So it broke because the market broke, and it's come all the way back. It just needs time to go sideways. But this is I buy, if I'm buying biotech stocks, I'm only buying an index, or they must have earnings and revenue growth. It's none of this stuff with zero earnings and revenue growth. I insist that they have the numbers, but this is where institutions are going to right now as well.
I want to play that through the XBI. I wanted to get down to the 21 day, but it bounced right off the 10 day today. Yeah. Trying to hang in there. I guess if it goes above this pivot, I don't know.
So this is a real nice way of playing it, Joseph, because so this is a lot of these are more, this is a way of playing a lot. The Kathy Woods genomic stocks, more speculative names, but you don't have that overnight risk in one stock.
Yeah,
And
that's
if
the
you
thing.
go,
Yeah.
if you go to and Google what's in the XBI, you have it's better than the BBH and the IBD, because in those you have you've got Gilead, Amgen, a lot of the bigger ones that don't have the earnings growth, but a lot of these are leading off the bottom. See, they bottomed at this index bottomed at 61.79, 62.18, while the market's still churning. So this is where leadership's coming from right here. I just can't buy an individual name in here. I've got to buy the bigger cap.
That reversal from about 2 weeks ago in the XPI was one of the best looking things I've seen in a long time.
Where's right here? Where from?
I'm not wearing my glasses. It was about 2 weeks ago, massive intraday reversal on big volume.
Well, look at the bottom, 26 million shares. There's the bottom right there. Yeah, so that's going back a little more than 2 weeks, Vaughn, but see, that's telling you the bottom's in.
Yeah. The
26.
It's about 15% or 10-15% over the 21 day coming into tomorrow's number. So I actually just closed it out really reluctantly.
Yeah.
Yeah, I don't blame you.
So Roy, quick question on that, and I kind of agree. If this was a bottom in this kind of an index, right, ETF of the biotech,
yeah.
From here going forward, because I just say that I used to be in pharmaceutical sales, so I have an idea of when things work and how they work.
Right. Right.
This would be a trend that you can get into for a while, like it was after the housing bubble. That those groups took off, but also at that time there was 3 federal rules they changed to help the biotech industry. You can look at them sometime, or I'll share them.
Okay.
They were very, very helpful to the industry, like speed of getting the drugs out, patient, all the coverage. So if you see this as a real trend, when this turns, the leaders always lead the group, right? But these won't, quote, stop again and start again, right? Over the next 6, 9, 12 months, whatever it may be. And if we're in a recession, this is going to help maybe show a lead of it, because it's also kind of, even though it's not considered consumer based, directly, you don't shop in the same way and buy something, but the products that are there have to be affordable for them to either choose it or the insurance companies, whatever category they're in, to keep that process going of growth, right? They don't come into these for a little while and get back out once they start.
This is the perfect, thank you so much for that. Look at this. Look at this is the monthly chart. See, look at when it finally bottomed there in 2011 and you got the move up. You got, this went from 25 to over 100. You got a 4-fold move in the next 3 years. So this is what got my attention. The volume that Vaughn pointed out or a week or two ago at the bottom with the volume explosion. And this is just off the bottom. See, by no means, if you're looking for new leadership groups, I mean, this is definitely got my attention. So you've had this massive bear market and people are looking for fresh names. I like it.
Yep. Can you, if you look at the IBD version of the biotech industry group,
okay,
on a monthly chart, that shows you how there was groups working during the housing bubble, but they hadn't, or stocks weren't working that well. But when they flipped, it was the innovate. It's, just like in other industries, it's about a 5-8 year flip when they come in with really new drugs like Genentech and Amgen did in the 90s, right?
Yeah.
There's these 5-8 year innovations that totally change the industry. And when they move, they move, but that one there, at least I understood some of it, was the regulations changed to kind of help them, because I think they wanted the economy to benefit in that area.
It makes the perfect, to me, and again, look, when you look at, this is from the NASDAQ Biotech Index, Daniel, from IBD down here. I'm not sure if that's the one that you're talking about, but this is what I'm looking for. 1, 2, 3. I mean, I'm looking for this. If you can double your account, and I fully believe coming out of the bear market, that's the best time that you can have a 3-digit return in your account, but you're going to have to concentrate and you're going to have to find a couple of these leaders that do it. And Wes and I we're looking at this religiously. because we're just trying to find the next leadership in conjunction with what's going on in the backdrop of the market. But look how this moved up 1, 2, 3, moved up 3.5 years. So look, this is the second month. And if we get, if you get a 3.5 year move, this thing goes to 10 to 12,000.
Right. Yep.
So, that's how you find the lead. This is, you just look through these things, you look under the surface, and there can be individual stocks that, lead us up to do that.
When you're done with the daily, can you overlay that with Regeneron on a monthly chart, or just show that on a monthly as in that one?
And then
you can do it there on the other.
Are you seeing that on my screen? The
No,
comparison?
just
You're
an
not?
ad.
Okay.
I mean, you can just show Regeneron on a monthly though, because Regeneron, I didn't know what I knew then about IBD. I was just learning the system, but I knew our company competed directly against their main drug for I think it was glaucoma. But they went from about 15, 17% market share to 70% market share against our drug. So it was like, forget about competition, right? Once you blow past certain levels in pharmaceutical that way too, it's the same thing in other industries, right? But the setup told you with Regeneron in the group, this thing's going to really hum along because it was just percolating. But the numbers, I think the EPS went from a negative to a +3 to like a +5 in those 2-3 years coming into 2011, 12, whatever it was. And that, if you see that, like you said, these aren't going to go up and down, up and down, up and down. Once they trend, they got to stay on trend because it's all based on sales after.
Yes, right. Yeah, remember, there's Zacks has covered this extensively, and Zacks, their process is based on earnings revisions and beating earnings expectations, constantly, beating the estimate and raising the number. And for you to do that, typically you have to have very solid sales growth, and that sales growth is going to be fueled typically with new products, coming in your pipeline. And as long as it takes a lot of these biotechs to go through phase 1, phase 2, phase 3, I'm just looking for I'm looking for some blockbuster new drugs that can drive the growth, Daniel, the way that you're talking about. It's going to be sales growth. It's going to be sales growth, new products, new innovation, new disruption. Where is it going to come from? They will show up on the charts.
Hey, Roy, it's Amit. I think
Hey, Amit.
one of the massive uptrends we had during COVID was stocks like Moderna and what's the one with Pfizer, the BioNTech. They jumped like fivefold in a year, right? And then they crashed back. So that's why this XBI biotech ETF, went up straight and then went down. It rolled over.
Yeah. Well, Moderna is more than a one product company. It's definitely a well-run company. I thought that this stock would have more legs, but look at the estimates coming down from $28 to $9, between this year and next year. That's
because the majority of revenue was from the COVID vaccines. And that revenue stream is not a sustainable like forever. Same thing with Pfizer or BioNTech.
Yeah. So,
Roy, where are you with China? Oh, sorry to interrupt. China? Sorry to interrupt. The other gentleman.
Oh, no. Let me pull up China. So I think I thought that China was definitely leading us out of this, leading group. China is actually easing right now, and they're the first country that's actually easing right now while everyone else is tightening. They've taken their medicine, so to speak. But China bottomed some time ago, but it became almost investable. You can see when China made the bottom. And by the way, guys, if we get a move like this, look, this is what you're looking for in the market. And so this is the entire Chinese market. And see that you're in this stage 4 downtrend. You're in this downtrend, and then it just accelerated. And President Xi came out with some new, not new tariffs, some restrictions on a lot of the Chinese stocks, and they got blasted. So you got JD, PDD, and those Alibaba,
Alibaba and Baidu.
Yeah, and Baidu, they got blasted. So that is what a market bottom looks like. Look at the volume and see from the bottom, the largest volume in history, and then it rallied back up, and then it's been making this higher low. So it's, it's showing you that the group is bottoming. But 2 days ago, China, they had a problem with Tencent and Alibaba, and they penalized them. They fined them for having too large of market share in their businesses. And so they really got crushed. And so there's the political risk. And so, they were down significantly, overnight. And, PDD was the leader. And so that was down 12% yesterday. So it's building this base. It's got really strong numbers when you look at it on the screen. It's firming up off the bottom. It's breaking through the 200-day, establishing a new downtrend, and then it gets obliterated. So it's just China's a dangerous market and I actually owned a couple of these stocks I'm just, trading 2 or 3 days, but these aren't investable.
Yeah. Zero COVID doesn't help either. Zero COVID.
The who?
Zero COVID.
Yeah. That's right. So they can, and I saw a story today where potentially China's going to shut down their economy at various times until 2027. So you can't, having that as a backdrop is just very difficult to own as an investment. I'm trying to, position and to find the leaders where you can take 5 and 10% concentrated positions, but that's just overnight risk, the political risk. And so JD was a leader as well. And, the numbers are quite good. And their economy is opening up, they're easing. And so that's why I like them. And you had a couple of, I guess this is really the number one growth stock outside of LNTH out there, where this stock is powered up. So it's Li Auto, a Chinese EV company. And again, this action is quite tepid here at the top, where it broke this 37. First of all, it went straight up, never pulled back. That's showing extreme power. And notice where it didn't even stop when it broke the 200-day, made it all the way back to new highs. And now the stock is sort of going sideways. But, I would definitely watch this stock. They launched a new SUV, and they've got tremendous numbers, but it's China. So how much do you want to risk when you can walk in and China can penalize them and it's down 10% overnight? just not having to do with earnings, but political risk. So that becomes quite challenging, I would think. But, you know, it hasn't done anything wrong. It hasn't broken the 21-day, but it's, you know, a lot of growth managers and hedge funds are following this one as well. And, you know, China and solar, you've got DQ, and there's a 3-day move down of pretty significant of 10% in 2 days. So, if, you know, again, if you tried to buy this on the breakout 2 days ago, you just got stopped out today. But look at the numbers. Look at the numbers, guys. 500% earnings growth, 400% revenue growth.
An interesting gap down in that BYDDF too, which I guess is just, you know, illiquidity, but it was, you know, leading similarly to that LI, but it just shows you some risk there too. Highlights it.
Yeah, the rumor was Buffett was selling. That's what hit that today.
Yeah.
Where's the IBD 50/50? Yeah, guys. So, you know, again, just to remind you, for, you know, on MarketSmith, you can find great ideas up here on when you open the stock ideas tab. We only had one stock that broke out today, DORM, and in the automobile parts area. And this is a great way of finding the next leaders when you're, you know, when you're trying to find, you know, well, who's holding up, who's close to their pivot. And they're, you know, a lot of these names aren't like great. Hershey's defensive, you know, you don't want to own, you know, you don't want to own Pepsi, you don't want to own Hershey, you don't want to own Kellogg, you don't want to own Service Corp, International Funeral Homes. You don't want to own any. There's just no leadership. But this is where you can find the ideas, recent breakouts, breakaway gap. And if you go to the weekly review, they're going to be here, guys, when the environment's right. Here's the IBD 50. And this is why, you know, I think this is so important as a tool in terms of screening. I mean, this is a fabulous, I've been using MarketSmith as long as it's been around. Before MarketSmith, they had a product that was called Daily Graphs. And I mean, I've been a subscriber for 20 years, over 20 years, actually 30 years before it was automated. But this is the IBD 50, and you're going to have leaders here. Notice here, there's DQ, Vertex, Celsius, there's that LI, there's IMXI that Minervini owns, Harmony. See, this is a real good list. There's Enphase. So this is where the leaders are going to, you know, you're going to have a lot of leaders that populate. You're going to have stocks from the market bottom on this list that double and triple. There's that LNTH that we looked at earlier. This EVH is a software company that broke out. This is the environment that we're in. Broke out, perfect breakout, market's bottoming, and look, you got stopped out today.
Yeah, I think I actually got stopped out the day before. I closed out half at maybe a 5-6% gain, went up to 12%, came all the way right back into break even.
Where did you buy it? If you were up 5%, you bought it coming in?
I bought it coming out of the high of 7-1. You got tight for those 2 days. I bought it through the high of that day with a stop at the low of that day. 7-5.
7-5.
Yeah, I bought it through the high of that bar, right there. Yeah, that big one.
See, that's really a perfect buy. That's really well done. Notice how tight. See, it came all the way back, went inside, and really in taking that out and buying it that day that's a perfect buy. And then you were Johnny on the spot in terms of locking in a profit, but there's your sell date, and then it followed through.
Well, yeah, if I may say, I'm kind of torn between, there's two options in this market. Either you can try and get these big leaders coming off the bottom, or you can play really tight risk management and make small gains. Like it seems like the max gain you can get is 8 to 12% in these names before they come back. You can play for those moves, or you can try to play for the big moves, but you're not really gonna make any profit in the meantime. You're just gonna be jockeyed around.
Or do you trade for a living? Do you trade your own account exclusively for a living?
Yeah.
So, if you're retired, if you have another job, it's almost impossible to do what you're doing, and you have to be sitting here to do exactly what you're talking about. And, but that is how you trade this market. That is how you trade the market that we're in today. And, you just, you scalp it and hope that you get, you hope that you can get a little bit of follow through and just, and constantly roll over your edge, the edge that you have. But that's a perfectly executed buy right where you bought it. And, ideally, if these stocks get tight, you want to buy them when they get tight before the breakout. Many times I like to buy them before the breakout and add to them in the breakout, average up, pyramid up. And then, in a good market, then you really, you can make some money. But let me see, what did PRVA is another one in this group. This one looks a little bit better. And, look at the numbers, see the numbers on this one. It's in the same group, great numbers, and look how tight it got. That's exactly what you want to see. But there's your trade taking out this 30 area 30. It was 30-30, and there's your buy point right there. And you've got a 4-day trade.
Yeah, but that's the thing. You can either take take 60 to 75% off for those 4-day moves.
Yeah.
But then if it becomes a big leader, you only have 25%. So it's either you take those profits fast, or you're not going to be able to get a big leader.
And for you to get a big leader, you want to get a big position. So you're the only way you're going to do that, it's hard because if you're watching your equity curve and you want your equity curve, if you're focusing on your equity curve, it's can only go higher when you sell into strength, when you take scalps. And, if you're selling and protecting your profit, or you have a stop to protect 25%, 75% of your profit or something like that, you give a lot back. And that's the challenge in the market is you can, you're more, you might have a $3,000 profit that goes to a $1,500 profit. Then, then you're frustrated because, you've lost $1,500, that's gotten away when you had $3,000, but you're not going to ever get the big leader unless you hold it, longer. That's the dilemma that we're in. That's the market that we're in. In a great bull market, this stock would go up 20% and then go sideways.
Yeah. So if you really want to stay profitable in this market, it feels like you just got to take those profits. And if you don't want to make money, you're going to have to give it room and just put your stop at break even as fast as you can. It's really tough.
And then it's the mental capital where you're wondering, well, why do I just sit here and just constantly break even when the market environment's not easy?
Yeah.
That's kind of where I'm at, because I try to hold longer and I just keep getting, like up to 10% and then reverse to break even. It's like, why am I even doing this right now? What am I doing?
Yeah, for sure.
They're they're just, they're going to come. I don't know where they're going to come, but I'm convinced that we're setting the stage for, we're setting the stage for having a great year from the market bottom, the way that we had, coming out of that market bottom in 2020. But the analogs that we see and that we've looked at, it might chop around for, we might chop around for, 3 or 4 months.
Yeah, and what's even more interesting is those at the trader line presentation, one of the presenters were using past precedents for when leaders broke out. And it was interesting because for almost half of the past precedents for bear markets, some of the leaders broke out months before the follow through day, but then other leaders, they broke out months after. So you have to always be paying attention no matter what. Some leaders lead, but some leaders break out months after. So you just always got to be there. You
do. And I'd made the point, Charlie, before we looked at this. When you go back and you look at the look and see who the biggest winners were in coming out of 2020. Some of them, like Tesla, bottomed at the 200-day, and it was rare that it was rare for a prior leader to come in 50% and then be another leader again. I mean, that's the only time that I've actually ever seen that happen. But Tesla bottomed when the market bottomed at 20, in 2020. Shopify was about 20% below the 200-day, but they had the product, but the 2020 bottom, 2020 bottom was about 20% below the 200-day. And then it had a big move. And then who was another big winner? Shopify, Tesla.
Maybe I think it was Teladoc. Teladoc didn't even break below the 21.
Oh, yeah.
It didn't even break below the 50-day.
Exactly. So so Teladoc was a winner back there in 2020 coming out of,
But I don't know how you would have caught that. That is a hard one. Like, look how choppy it is during that COVID lows. It didn't even break below the 50-day though. The strength there is crazy, but how do you get in?
I had, this was very difficult to trade. Look at that. Look at where you look. So look at this, the numbers were improving just like DocuSign and this is before the endemic. See, this is before that occurred. There's the January top. And this is right before the pandemic hit. So look at where it broke out on earnings. So you had a perfect breakout. And then, man, I don't know how I tried to trade this stock, some with success, probably got stopped out. That's just essentially untradeable as well.
Pull up Fastly. It broke out way after the follow through day, I feel like. Maybe May. Yeah. Okay, so a month after. So you get names that come after.
Yeah, that's what and look at Fastly, they had a new, supposedly they were going to change the world with edge computing. And this is what you want to look for. And this is one of our examples along with Livongo and DocuSign, but a Datadog. You want to see, what's that date? So May 7th, 2020. See, this is why you can't take any time off right here, guys, because you only need to get one of these, May 20. And there's the breakout, that was on May 7th. See, the environment can change when you see that. And now, so the stock is up 45% on volume up 600%, going to a new high. And this was, I forget what the news was, but a lot of us owned this stock right there that day. And that's really what you want to see. You want to see, that's the action that you want to see. And
were you buying on that first day gap up?
I did buy it on that first day gap up.
How do you manage risk?
It's very difficult. It's, you're watching the intraday chart to see if the stock is going, where's the stock going to close? You got hints, you want to buy it, you want to get your whole position in. If it closes that way, Jim Ropel is famous for that. He likes to take 17% positions in his fund, and he's all in, buying it the whole way up, getting in that day when you had the action. There's the character change and the signal. So you want to be in that day. And, here, and depending on where you bought it on day two, there's your stop below that low at 31, below the low of the second day. And, where'd this stock end up peaking?
I think maybe yeah, there you go.
Yeah. So you got, so the stock, if you bought the stock right here at 40 and held it the whole way, you got that first double. And really, that's what I'm trying to do, what I'm trying to identify right now. These few and far between, but notice it didn't do anything for months, and then the character changed. So I'm waiting for evidence, and the evidence is volume. So you want to run the volume screens every day. What's up on big volume? And see, and more than likely there were some analyst reports, an upgrade, something happened. Then they did a secondary right there. This is a perfect example of you just need a couple of these.
So let's say this downtrend we have right now, right?
Yeah.
Let's say earnings season is about to be upon us. So maybe we might find a name that breaks out like this. If we're still in the confirmed downtrend, and the earnings come out, and you see that night that the volume's higher than a whole day, the volume's going to be high the next day, like the highest volume ever. Would you give it a chance the next day? Would you buy it even if we're still in a downtrend, or you're going to wait? The overall market's in a downtrend still, or are you going to wait for the follow through day or something along those lines?
I'm looking to take. Yeah, I'm down here with the, as Larry mentioned earlier, with the sentiment so bad, and we're at historical levels in many areas. I'm looking to add exposure. That'd be, I would put exposure on, but for clients, I want to have a 10% position immediately, in my PA. But for clients, you can only put on partial positions to see and use progressive exposure. That's the only way you can do it, to see if you can get a little traction. But, I would put 1%, 2 at most, if I'm, in client accounts. But, I'm trying to get 10% or 15% or even 20. If I can, if it's the right merchandise, if it's showing you the right elements of a new market leader. But it's got to look like that. It's got to be breaking out on big volume to a new high, and it's going to probably be earnings. And earnings season is, and so we're sitting here. So in the meantime, you have these stocks like LNTH, where we talked about this, where if it just goes sideways, you have a pivot 2 days ago, you can put on a little bit there and then see what happens with the market, and then press it at 73, have your whole position at 73, 78. And if you're averaging up, then you're going to be profitable. And the only thing that you're going to risk then are your profits. And you're going to have to risk your profits in hopes of getting a new lead, a big winner, something that can go from 75 to 150.
One thing I'd have to say about these gap ups, Joseph, is there's a trader called Ray at TraderLion.
Yeah.
One of his biggest edges is trading these gap ups, highest volume ever. That's his edge, he calls it. He trades the day two as it pushes through the high volume close. So that might be something you want to study.
I missed his presentation. I've taped it, but I want to see it. Richard Moglen said he's an extraordinary trader.
Yeah, he was up, I think 540% in 2020.
Yeah,
I wrote notes on his presentation. Yeah, he's really great.
So, if Richard Moglen likes him, I like him.
Yep, for sure.
Yeah. So,
Hey, Roy, can we, sorry, Roy, can we go back to the NASDAQ chart and
yes,
SPY chart to see, in addition to earnings, there is risk of tomorrow's CPI number if it doesn't go lower, as well as the interest rate hike pending on July 27th.
yes.
What do you see as a drawdown risk from where we are?
I think the drawdown risk is we take out the lows, and the NASDAQ, there, and that's actually 98.50. That's actually around 98.50. There's your risk, the short-term risk, and it doesn't mean that I just see downside risk in the NASDAQ stocks. And let me show you something else on a different screen. Another way of something that I was looking at that I've studied as well, based on our risk, based on the risk parameters. Let me share my screen. Okay, this is a different type of chart. Do you guys see this? This is the NASDAQ. This is AIQ.
Yeah.
Yeah, we can see it.
Okay, so this is what you're looking at. So this is the Fibonacci retracement from the bottom in 2020 all the way to the top of the market in November. And notice these pullback levels. These would be consistent levels of thought that where the indexes might bottom. There's your 23% retracement. There's 38. We took that out. There's 50. We took that out. The next level is 61 at 10,344. That would be your downside risk. And you can see that I've got a line here. That's when the pandemic began. There's your next level of 98.50. So there's your potential drawdown. And that's really what I would like to see. And I'd like to see us have some type of watershed event the way this happened in April and May. So I would like, if we do that, that's going to be, the NASDAQ's going to be down 45%. And that's going to be a significant level. I believe that's going to be the market bottom. And, it's going to be up there with among the largest drops that we've had in the NASDAQ. And I mean, there's going to be a tradable bottom right there. Fear's going to escalate. People are going to panic. If that happens, you take that out, you can go through these levels and you can get a sharp move, just a sharp move down. If that happens, it's going to be more problematic if the market reacts positively tomorrow to the number, whatever the number is. It's going to be problematic because there aren't any leaders. There's no leadership. I probably, as a trader, I would buy the stocks that I've talked about before as potential leaders, but these are purely trading calls because I just don't think it's over in terms of the valuation adjustments and where Wall Street, what needs to happen from Wall Street's perspective. But there's your downside emit right there. And if you take a look at the S&P 500, and these are the levels that you're looking at on the S&P. So the yellow line is the 50-month. This is a 50-month. That's why I said the next downside is right there. That's at 34.75. And you can notice the 2020 bottom. See, we went through the yellow line, the 50-month. You hit it in 2018, the bottom. There's the 15.16. So this is this is a really good chart to take a look at. So the Fibonacci retracement here, 50% retracement brings you right at the 50-month. If the proverbial, what hits the fan, the next level is roughly 3,100, 3,200. And then you start talking about 3,000 based on a valuation call at the bottom of the market from a valuation if all these earnings have to come down. So there is, remember the S&P was only down 20 something percent from the high to the low. And bear market recessions, the S&P typically goes down 34%. So you have 10% more downside really in both averages, I feel. And I do feel like it's coming. I think it's coming quickly. And I think we're going to hit it, this month, next month, or the next month. Like it just depends on. You can go sideways and then go lower. But we're going through earnings period, earnings season. I wouldn't be surprised at all if we hit 34.50 this month. If we get some kind of crescendo down, and then the markets can try to stabilize. But that's what you want to avoid. You want to avoid that last 10% down. And remember, this is, by no means am I predicting anything. I don't have a crystal ball. I'm just looking at the tools and trying to gauge sentiment, market breadth, what's happened in prior bear market lows, knowing that you have to have the tools like follow through days, volume accumulation, and various technical tools.
Roy, it seems to me that if we compare this to like 2008 or 2000, why we have a long way down to go. Is that... Well,
John, look at down here too, and I'm going to change the date here. But see, notice here, we're not even at the 50 months. See the yellow line?
Mm-hmm.
So let's go back and see, like, worst case. Let's change our date here, and here's 2008 to 2009. See where we hit the 50-month, you got a little limp bounce, and then we just rode over.
Yeah, that's what I've seen is we, on both of those corrections, we ended up 40% below the 50-month, I believe.
So that's why I'm so reticent of buying when there's no merchandise. You're trying to squeeze blood out of a turnip, and the environment's not right. So, I do know that if we get a bounce, that for my clients, I'll probably put on some shorts on the bounce, in the SQQQ and the inverse ETFs, because they're here you either have to have sitting out power, or you just can't get caught in this environment somehow. And I do recall, I think I lost 10% both years in 2008 and 2009, but I made it up. You can see when we finally bottomed,
mm-hmm.
I made it up in less than 2 months after being in a market downturn for 2 years. So you've got to be there. You're going to have, if you dip your toe in, if you probe, you're going to have some burns on your hand, but the idea is not to get torched, and keep those to a minimum. But you're going to have these times here. This bounce off the 50-month gave you a nice trading opportunity that lasted 8 weeks, and then it rolled over. So it depends on how high. There's going to be trading. They're going to be trading bounces and opportunities. You had a 3-week bounce here, 3-month bounce here, tepid, but you did have a bounce, and then it rolled over. But that is what's concerned me, is that we might hit this 50-month and we might bounce off of it and then roll over again. And there's the 2000 top. See the same thing where you came into the 50-month and
right,
then
had a big rally.
Yeah. So you had a big rally for a couple of months, but you're in that downtrend. And, so if we're in a period like this, there are going to be periods of time where, look, you had a 4-month rally off this bottom, in, late 01. So, you had to trade these bounces, but you're in the midst of, it's very hard to trade in, very short-term bounces when you have an intermediate or long-term and a long-term downtrend. And I remember this clear. Well, I remember 09 that things didn't get better until like March. Yes, so things really didn't get better until March of 09. Stocks, they bottomed here. Well, there's March 09. So we bottomed in late 08. And finally, it took until March of 09 before things turned more promising. And same thing, it was March in 03, coming off the bottom too, where we finally bottomed. So, you just have to be prepared. You've got to be prepared that this, we may be in a bear market that is significantly longer than people expect. But as long as you follow the trend and stay on the right side of the trend, that's going to protect you. It might mean that you don't make any money for, another 6 months, another year, or it might mean that, if we bottom, in the next month or two, and stocks start showing up on the screen, and they have the right action, then the low's in, and you're off to a triple-digit year. And no one's going to know that, but these are the tools, John, of course, to look at, to gauge, and to manage your risk.
Okay, you mentioned, Wesley, I guess, mentioned earlier, the new number of new highs and new lows.
Yeah.
The only place I know to get that in MarketSmith is the daily market indicators for the NASDAQ anyway. It's ticker NASDQ. And it just shows the 10-day moving averages for new highs and lows.
You can get it on stocks. We get ours from stockcharts.com.
Okay. If you compare it to put in NASDQ.
Okay, hold on. Let me share my screen. New share. What's the symbol, John?
NASDQ. And put it on daily. You have to have it on daily.
That NASDQ doesn't show up on my screen.
Yeah, well, put it on daily. Put it on daily.
Okay. Okay, here. That's okay.
The bottom one is the 10-day moving average of new highs and new lows.
Yeah.
And that seems close to what you were looking at. Wesley was showing as far as new highs and new lows. It's smoothed out a little bit from the 10-day average.
And the new low, yeah, see there it is. See again, look at that 20 new lows. And this needs to be flipped and going the other direction.
You can see back on November 22nd where they crossed.
Right there.
When they crossed, that was when Minervini said to get out of it, and that looks like a good indicator there. And obviously it zigzagged back and forth for a year or so. But
that is, the chart that Wes showed earlier demonstrated too that it just demonstrated clearly, when it's very difficult to find 1 or 2 or 3, 4 stocks that go up when the market environment is going the other way. And even under the surface, I remember last year it was so choppy, and on the FFTY where you got so many false signals of getting in, getting out, and finally, you got the real exit signal in November, but January, when the market broke the 50. But until this improves and you get the crossover, it's going to be difficult. But that's a very astute point that you're making, John. This is a great way of watching that. So when you see this inch up and crossover, the environment's changing.
Yeah. I hadn't used it much before a month or two ago. And
that's
a pretty good indicator.
That looks great.
Did you look at copper prices at all tonight?
Yep.
Well, I didn't.
I'll pull it up.
They've been going down precipitously, and you mentioned all the companies warning. I mean, Tesla's telling everybody to get to the office or get out, and Facebook's telling people that they're better get with it or they'll be without a job. Do you ever remember that many companies saying stuff like that before?
I think it's their way of reducing their head count, and because what's going to happen, you're going to have more and more of these companies that they're using that as cover, like, get back that politically, they can use that for cover, but the problem is their profitability and operating profit, and that they're being constrained, so they're not being able to pass through, their price increases enough, so they're going to have to reduce headcount. Remember, employment's a lagging indicator, so that the job number of 377,000 net new jobs, last Friday, that's a lagging indicator. But no, I've never seen it like this. This is going down to be a humdinger. And so this is telling you that you're in a recession, or you're going into a recession. Copper is in everything, in the industrial markets, and the prices are telling you that. So it's just interesting that all these prices peaked, and they peaked months ago. Like energy peaked right when Ukraine invaded, Russia invaded Ukraine, and but all these commodities are way off their high. So inflation has peaked. Inflation's peaked, but you have lagging numbers. What's the three biggest components of inflation that you're going to hear about tomorrow? Are excess or rent, or it's rent. It's called what's the term?
Yeah, you're thinking owner's equivalent.
Yeah.
Rent? Yes.
Yeah. So owner's equivalent rent, and rent is going up 1% a month. So even if so rent is going to be going up 12%, and that's about, I think that had an impact. That's about 3% of inflation, and then you had again still energy cost and food costs that are still sky high. That's a lagging indicator as well. But if the number goes higher, it's going to be because of that. But under the surface, then all these commodities, see, they have peaked. Corn's peaked. Look at wheat. So despite what you hear about the shortages in wheat, because Ukraine produces 40% in Eastern Europe. Look at what happened. Wheat prices are down 40%. So it's very difficult to explain. But this is inflation. Inflation's coming out of the system. There's energy and oil. So you can be assured that inflation has peaked. So the people are seeing this, and that's why I wonder if they're going to, will they potentially buy a high number thinking that that's the headline number is as high as it's going to get tomorrow? And I don't know, but you can clearly see, in the metals and the, and metals, food, energy. I mean, commodities have peaked. There's gasoline that's down 25%. Gasoline went down 27 straight days. So this hasn't really made it to the pump, I don't believe. This is a lagging indicator, but gasoline's peaked there because of demand destruction. See how difficult it is when you're seeing all these conflicting, ideas that you have to put the pieces together. There's lumber. Look at lumber. Lumber's way off the high.
The market shook off last week's jobs report, which would tell you that even if we do have a high print tomorrow, it might shake it off again, which is where it gets frustrating, because you could make the case for taking exposure based on that, but I'm not going to. But
I got a question, Roy. Now, given you're always talking, like in the last 5 minutes, everything's a lagging indicator. Does that mean, since we already kind of know that the Fed always overdoes it when they raise rates, can we be assured that they're going to do it again based on exactly what you've been saying?
Yes, I think so. And I can't imagine, remember the table that we had in the slide deck where Wesley showed the Fed funds rate and the inflation rate? So if inflation gets to 5%, I mean, if Fed funds go to 6%, nobody's expecting that. See, that would be an extreme surprise. And I'm not saying that that's happened. What's happening right now are rates are coming in a little bit on the 10-year, because of now we're moving from worried about the Fed hike to worried about a recession and numbers getting cut. So we're just in an unusual place. But you see where, Fed funds should right now they're targeted to be at what 3.63% or something like that next year. And that means that inflation should be under that, like at 3%. Inflation's not going to 3%. And in the next 9 months, I don't believe.
Yeah. Well, Joseph may be right about tomorrow, because I mean, if you look at futures, they're up slightly. Not that it means anything at this point in the night, but I mean, they're not running for the hills.
Well, it doesn't mean anything. And this is what's amazing is, okay, so the White House spokesman, Jean-Pierre, whatever her name is, last night she was quoted as saying get braced for an extremely high inflation number. So, that was on the wires. Now, she said the same thing before the last number as well. And then the market got absolutely crushed. And so everybody knows the number is going to be high. So you can't go into that number with really any exposure. You just can't. When everything that we covered today suggests that you've got to, now it's time to protect for Armageddon, for that to happen. And it's going to be, the action's going to be important tomorrow. And we could rally on a high number. It doesn't matter what the number is. The market can rally because we're oversold, but it doesn't, the Fed's going to have to, they're in a box and they're going to have to continue to raise rates. And that's the dilemma. It just means, like those other analogs, we might go sideways, up and down. And, and time is going to show some new leadership. We just don't have it yet. So it's going to be interesting, but there's a lot of bearish sentiment, and I'm bearish too, because of the stuff that we're talking about, just the trends down. And you don't want to fight the Fed, and the Fed's tightening, they're not easing, and quantitative tightening is coming. And the environment is, they're taking liquidity out of the system, not adding liquidity into the system. So these are some headwinds. So, it's one of those times where I'm really, really, really paying attention to the headwinds. And, but we'll just see how the market reacts, but I don't know how the market's going to react tomorrow, but we're in a downtrend. It's bearish. We could rally just because we're down so much.
Hey, Roy, can you hear me? This is Bill Will.
Hey, Bill.
I'm going to have to sign off, but I wanted to just make one observation about all we've been talking about for the last hour.
Okay.
Last month and last week and last several weeks, I have made notes about what I think the places that are crowded or not crowded and all that sort of thing. But one of the things I've been writing down for the last month, and that is that earnings reports were going to be coming out in early July. That's this month. And I expect them to be bad. but one or two things can happen. The market will go down on the bad news, which I saw it start today with Microsoft,
Right.
or it could just roll over tomorrow and sell the bad news. Now, I'm looking for another thing to happen before I get much very long this market, and that is, when can stocks start going up on bad news? And I haven't seen that yet. But all bear markets most of the time end when the bad news is out and the stocks don't stop going down. So that's pretty simple stuff, but that's just instinct. That's anecdotal, okay?
Yep.
But believe it, it's true though.
Yep. Yeah, I agree.
And so I'm doing what Roy's been talking about tonight, and that is trying to write up a list of names of stocks that are setting up that where the earnings and the sales are really going through the roof on the upside. Those are going to be the next big winners, and I have no idea. We may have a complete washout week after next. I don't know, but it wouldn't surprise me to see this market, really get panicked. And what will happen is the record will show the market was down 84% this year to date. But the problem is, it's all going to happen in one day. It's going to go down all maybe 2 days, and then it's going to be. And the history will show the market was off this year, 64% or something at this low. That's what the news media was to talk about. But if you haven't sold before then, it's too late. I mean, you're just going to have to. You can trim your sales, have a little more cash, sleep better at night, but you don't want to be dumping everything into a panic.
Right.
Or when it's down 60 or 70 points on the Dow or the S&P, or So anyway, with that, I'm gonna say good night to you guys and hit the sack. Okay.
Thank you, Bill. And I'll see you for lunch shortly.
Okay. All right. Take care.
And Bill made a great point, and it's what's going to be difficult. It's getting exposure in at the market bottom when I want to see the highest volume that we've ever traded. That's I won't, if those things come together and the VIX spikes over 43, put call spikes, you're going to be going through these levels. And that's why you have to pick, we looked at those Fibonacci tracement levels in those points. That's where you just have to start adding exposure. And, the best way of doing that is, I'm going to the S&P. That's probably, I may buy the Russell 2000, the S&P, and the NASDAQ, those three things, and just try to average in, but I'm looking for the bottom. I'm trying to get the bottom when there's a climactic fear, panic low. But we're not going to know who those individual stocks are yet. And then I'm going to come in later and add the individual stocks because they'll be more obvious. So,
Roy, how important is sentiment to you? That's typically what I watch for in this period. And if you look, back where we were 3 weeks ago, you could make the case that we might see a climactic bottom and not hit a new low on sentiment. So is sentiment going to be important to you, when you make that decision?
No, I think sentiment's there. But I think sentiment is a necessary agreement, indeed. And sentiment is there. There's enough bear sentiment. We just don't have that capitulation. We have the breadth that's there that Larry mentioned earlier. We're at levels where, this is typical bottoming action, but these levels can stay elevated for longer than you might think. And everybody's waiting for what I'm telling you. And that's, so then you have to put on your other hat and say, well, if everybody's waiting there, will we ever get there? And you might get there, you might throw in the towel and try to go long thinking that we're in a major new uptrend starting tomorrow, only to be dismayed that you take out the lows, 30 days from now or 2 weeks from now. This is, I mean, right here is this is the hardest environment that I've seen since 2007, 2009, like right here.
Yeah.
I agree. I look at the charts and like you said, outside of LNTH and biotech, it's a struggle.
Yeah. And you know, the names that Minervini owns, these are all, many of them are like second tier names, you know. So you don't have great, powerful earnings companies that are dominant, that can be big stocks with a huge total addressable market. You know, we just don't have any of those.
Agreed.
Guys, I think I'm gonna call it a night. Listen, I wanted to thank you for attending tonight. Wes and I really appreciate it. We hope that we gave you some tools and information in your toolbox to help you make better investment decisions. But look, this is, you know, the environment's going to get better. The environment's going to get better. We're setting up, you know, for a great new bull market. Just don't give up right when, you know, right when the market is about to turn. So, you know, keep doing your homework, keep searching for those leaders, and may you indeed have great investment success.
Thank you, Roy. Have a great night.
Okay, guys.
See you, Roy. Thank you.
Thanks, Roy. Good night.
You're welcome.
Thank you, Roy.
You're welcome.
Thank you, Roy.